Yield environment supported risk appetite through the Asia session. We've certainly seen that up by 1.2% on Asian equities. But this is what we're seeing right now at the long end of the US curve. The 30-year yield actually going higher once again. It's not back over 5% by any stretch, but 4.87, it's not a million miles away. We did see that big drop in yields yesterday, to Tom's point. Now, this is the dollar index. It's been supported by those moves in yields of late. Fairly range-bound this morning. A little bit of movement in the dollar, a little bit lower, but fairly flat, actually. Brent crude has not been flat. We were down more than 5% on WTI in yesterday's session. Brent also moving a lot lower today. We're back up a little at 86 is the handle.
And the drop in energy prices, of course, weighed on the energy sector in Europe yesterday. Currently, futures pointing to gains across the European major indexes. We'll see if that holds, Anna.
Yeah, pointing to gains, but not much. And in fact, as we've been going through this morning's session, Tom, you're pointing out the change in the dynamics around bond markets in the US, and that is changing the risk appetite approach to stocks as well. So as we now see those yields on the long end pick up once again, not at 5%, but starting to pick up again, does that take the edge off the gains that we make here in Europe? Certainly, US futures have paired and are in negative territory right now. But the Spanish IBEX still finds room for improvement this morning, so up by 0.5%. The FTSE 100 up by 0.2%. So we are bouncing a little bit from the weakness of the last 24 hours for risk assets. And this is what we see on FX. Not a great deal of movement, only grey boxes on the FX screen, just telling you things are calmer on the dollar and all of the other major currencies here in Europe as well. In terms of sovereign bonds, then, we are back to selling those, and we are seeing some movement higher in yields. I mentioned the US story, but that is filtering through then, Tom, into Europe as well, where we do see those yields going a little higher. And what strikes me as interesting here, sure, we've got the Spanish 2-year, but this is 30-year, 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 30-year. So it's a long end, once again, that seems to be showing us those outsized moves in this morning's trading session. Back to a theme of yesterday, I suppose. And Brent crude up by 0.7%. 86.44 is the handle. Tom, what do you see on the sector breakdown?
Well, we'll reflect. This very much seems like this is a market that's still looking for the next catalyst after we had that data out of the US yesterday. Maybe that catalyst comes through with the non-farm payrolls in the US tomorrow. Maybe for the UK and the gilt market, it comes through with the inflation expectations survey that comes out of the BOE around 9:30 local time. Across your sectors then, energy is actually down 0.2%, and the leading losses came through from this sector yesterday for European stocks. Of course, we are still in an environment in the first couple of minutes where European stocks look like they are on course, at least for now, very early days, of course, to snap 3 days of losses. Real estate also took a hit yesterday, as did basic resources. Across your sectors right now, basic resources actually adding gains just about 0.1%, so making up some of the losses, at least marginally, of yesterday. Technology is gaining 0.5%. You're also seeing a few decent gains for banks, for example, adding about 0.5. Travel and leisure also up 0.7%. Another sector in the red, though, autos, currently flat. Concern, of course, from some about the prospects for the auto sector and how that could weigh on the DAX. But currently, that is the picture again. It does feel like a market that is looking for the next catalyst. Across your benchmark, European Stoxx 600 gains of 0.2%, Anna.
Okay, so that's the sector breakdown, and modest gains then across European stocks. Let's get to Sophia Holter-Acosta, who joins us from the Markets Today blog and can take us through some of the market moves this morning. And in keeping with what we're seeing, this sort of to and fro, this push and pull around the bond markets and stocks, and the way that yields go higher send stocks lower and vice versa. There's a lot of focus on that, and there's a lot of focus, and we've seen this from Barclays, on what it is that changes the direction for bonds. We thought maybe we'd seen that in the last 24 hours, but maybe not. And they're talking about the link again between stocks and bonds.
Yeah, only essentially a crash in stocks would convince people to go back into bonds. That's the view of strategists at Barclays. They're saying, even a 5% drop in the S&P 2,500 is really not enough. And there isn't a magic level of yields that will really draw funds back into the market. I mean, I think this is, for me, is interesting, because if markets do crash, what would be the catalyst for that? I mean, Tom was just talking about a market looking for catalyst. You also need a catalyst or some kind of crisis in confidence for that to happen, right? And I do think markets are already kind of, the higher for longer narrative has already been priced into the market for so long now, even though it gets priced out ever so often, that, you know, I think Barclays here is saying, hey guys, this is unlikely to happen, and bonds are unlikely to get that rescue unless we do get some kind of black swan events that we're not seeing right now.
Yeah, and of course, towards the tail end of summer and up until about now, both bonds and equities have been moving in sync and moving lower. Bill Gross saying that, telling our team stateside that 5% looks decent in terms of yields and in terms of whether or not you want to be buying at this point. Not excellent, not brilliant, but decent. What do you make of the comments from the once known bond king?
I like the language that he used, because it was just so measured. 5% yield is decent. The bond market is a little oversold, so not really kind of going strong either way. He is pointing to an interesting dynamic in the bond market right now, which is the outflows from ETFs. So retail investors also taking part in this sell-off. This is something that has been kind of part of the narrative also this week. And if you look at the data, it actually supports what he's saying. So $500 million was withdrawn from one of the biggest US bond funds, one of the biggest US bond ETFs, I should say, last week. Let's see if that data carries through to this week as well. But if you do get this kind of rush to sell and retail investors taking part in that, then obviously you get an acceleration in the sell-off. So Gross is saying that, you know, they're joining in the crowd. We're seeing a little bit of an oversold market. He seems quite calm, though, Tom. A little bit more calm than perhaps the strategists at Barclays are, that are predicting kind of more sell-off in bonds unless we do get a crash in equities.
Yeah, and interesting that, you know, it's easy to not be calm, I suppose, when you read our stories that talk about the scale of the sell-off we've seen in bonds and put that in the context of all the tantrums that we've seen in the past, you know, post-dot-com bubble sell-off in stocks, for example, and talk about the percentages, and they don't look all that different. Let me ask you about what's going on with China, though, because there's a constant watch for us here in Europe, of course. We've got actually, along the theme of, are we nearly there yet? Have we bottomed on Chinese negativity? Citi raising its guidance on GDP for China.
Yeah, so I think if we're looking for catalysts, I think China could potentially provide one. China is shut this week. But Citi was actually one of the most bearish economists on the street when it came to GDP growth this year. Now they're expecting 5% growth from 4.7%. That's kind of in line with what most people expect, and it's also what the government is targeting for this year. But they're saying there is kind of better, there are signs that the economy is doing better than thought. This is a crucial week for consumer sentiment, though. If we look at the data, people are traveling more, people are spending more. China is shut for a holiday, but this is a very important holiday where the majority of the country travels, spends money, goes out, eats at restaurants. So I think this is a crucial test for whether consumer confidence is really turning the corner here. You know, the fact that Citigroup is revising its GDP forecast mainly because of what's happening on the industrial production side, and the property market may be doing a little bit better, they're missing the consumer story. And I think next week we could get a read on how the Chinese consumer is doing, and maybe, Tom, that will be the catalyst for the market.
Well, yeah, and as you say, the data seems to be suggesting that the consumer is regaining some of that confidence. I wonder, in the order, and you're right, absolutely, to point to that importance around the pivot, whether we're convinced that the Chinese consumer is back. And that, of course, ties to the real estate market, because they need to have confidence that their properties are not going to continue to fall in value. So we continue to have to look at that segment of the economy as well.
Yes, exactly. It's a feed-through, right? The consumer confidence is essentially the silver bullet that will rescue the Chinese growth story, right? Because if you don't have confidence, then you're not going to have people going out and buying property. I mean, it's the first-time home buyer market that's still kind of like here in the UK, dragging the rest of the market lower, but also you don't have people spending on things like washing machines and big-ticket items that really drive the economic story. And again, confidence is the underlying factor behind all of that. And how do you revive confidence? I mean, Tom, you know, I think if policymakers in Beijing knew that, they would have done that already, right?
Okay, Sophia Horto-Acosta, thank you very much indeed. Of course, with the analysis on China and a look at these bond markets, and of course the read-through in terms of equities and that call from Barclays that you need to see a sharp slowdown in terms of the equity markets, a sharp drop for the equity markets to turn more constructive on treasuries. You can get more, of course, from Sophia and the rest of the team on the front page of the Bloomberg UK website by typing TLiveGo on the terminal. Now, we talked about and touched on the oil story in the top of the market here there, and oil is clawing back a little of the ground today. Just checking in on Brent, currently up 0.4%, WTI at $84 a barrel after signs of weaker demand sparked the steepest one-day drop in WTI in more than a year yesterday, Anna.
Yeah, absolutely. We saw the weakest seasonal demand for gasoline in 25 years, and it was that data out of the US that really spooked markets and focused us back on the demand story, because for so long we've been focused on tightness of supply. Will we get to $100 a barrel? And yesterday looked very different, but we do see that slight bounce today. Coming up on the programme, we take a look at the stocks on the move this morning, including Metro Bank plunging after hiring Morgan Stanley to explore a potential capital raise. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
This is Markets Today. Welcome back to the programme. 12 minutes into the European trading session, showing modest gains across European markets. US futures, though, do point a little lower, down by about 0.2% on E-minis and Nasdaq futures. Let's get a check on the individual stocks on the move. There are plenty of them this morning. Joe Easton has a briefing. Joe.
So we've got a big unch on the screen here, unchanged for Alstom at the moment. This is because the stock is in a trading halt, but I had a look in the opening auction. It's getting absolutely slammed in those pre-market indications. I was seeing double-digit percentage declines, but as I say, halted at the moment as they announce a 1.5 billion euro decline in their free cash flow. And we are seeing some read across in Siemens, but only a 1% decline. The rival train maker also slipping as Alstom called sharply lower. Bit more positive down the bottom, charm bracelets boosting Pandora. They raised their guidance following a share price slump last year. That stock is coming back up over in Copenhagen. And a big gainer in Germany is SMA Solar, the renewable energy company, solar panels. Solar panels has been hit recently by interest rate worries. So that is a bit of a relief. Strong orders for them, and that one rising 13% on the DAX index. In terms of the other big mover, well, that's potentially may even beat Alstom today. Metro Bank down 27%. Reports from Bloomberg and also Sky News saying the company will potentially have to tap investors for hundreds of millions more pounds due to issues around their capital disclosures and how they're doing that. That stock has fallen dramatically since it went public around a decade ago. One other stock in the UK that looked interesting to me was Unite Group. Now, they say they cannot build enough student housing and invest in enough student housing at the moment. A lot of private landlords are being squeezed out because of the rising mortgage rates, and companies like Unite that make student halls are seeing really strong demand because of that. Imperial Brands in tobacco coming back up after that big slump yesterday, down more than a fifth for the year, though, given the worries about the UK restricting smoking sales, and that is 10% of their market, but we're seeing a bit of a relief in that one. And a big decliner, this is the real estate company Cofinimo. Now, they have announced they've had to raise capital, raise fresh funds. Again, it's interest rates related due to the real estate worries, and that is big concerns around capital for those sectors. Then finally, on the ratings changes, a couple of interesting ones stood out to me before the open. Now, Sandoz is getting 4 buy ratings this morning. JP Morgan is one of them. Morgan Stanley is another one. Morgan Stanley says the stock's worth 31 Swiss francs, trading at 25. Aberdeen, they're a new buy over at Panmure Gordon. Finally, some relief for that one. Sold off heavily due to worries about asset management outflows. Barclays goes underweight on Elekta. This is MRI scanners seeing a slowdown in orders, according to Barclays. And finally, Citi is neutral on Vodafone, saying they are seeing competition worries over in Germany. That one slipping by 0.3%.
OK, Joe Easton, thank you very much indeed from our equities team. Let's get back to the broader markets now. Barclays have warned that global bonds are doomed to keep failing unless a sustained slump in equities revives the appeal of fixed income assets. This as the rout in treasuries has sent shockwaves through the bond market as investors position for rates to stay higher for longer. Joining us now is Haig Bathgate, Head of Investments at Atomos Wealth. Haig, do you align with that view? Are Barclays right? You need to see a sharp sell-off in equities in order to see money move back convincingly back into the bond markets.
Yeah, I mean, I think the two things are sort of related at the moment. It's a classic risk-off that we're seeing, and we've now started seeing this sort of correlation reappear between equities and bonds, which you normally don't get. So the 60-40 portfolio is obviously struggling again this year. I mean, obviously everything is predicated on what you think is going to happen with future yields, and future yields are going to be impacted by what happens with employment. And we saw that this was all triggered again on the back of stronger jobs data in the US.
And given that what we've seen on the data front and what we expect to see then, Haig, good morning to you. What is your current up-to-date description of what we should expect to see in the US economy? I mean, soft landing, hard landing, recessions. When and what do you expect?
Yeah, so I mean, you can see, I mean, we've had such volatility. Everybody was, hardly anybody predicted the inflation spike that we've had. Very few people predicted that it would be as long-lasting as it is. So the idea that we're just going to sort of glide back and have a soft landing, I think, is quite fanciful. So it's not going to work out the way we are. We've had very high elevated levels of rates now for quite a period of time. We have to see how that manifests itself both for the consumer and for highly indebted companies. There's a funding wall coming up for corporate debt in about a year's time as well. So we're going to start to see more corporate failures if rates are sustained at the current level. But on a long-term view, as a private investor, if you're getting paid 5% on a US Treasury or on a government bond, I think on a long-term view that looks great value. I just don't think that in 10 years' time rates will sustain at an average of 5%, which is obviously what the bond market.
So to be clear, you would be buying the long end of the curve right now?
Yeah, if you could buy them and tuck them away and not have to worry about it, getting a 5% compound return looks very, very attractive to me.
Why do you say that the yield won't stay up at these levels? Is that because you don't think that inflation is going to settle at elevated levels?
Yeah, I think so. I mean, I think the higher it rises, and obviously what we're seeing is that there's always a latent impact of increasing rates, and central banks will always tighten too much, and then they'll choke off demand. In the UK, obviously, we've got sort of terrible dynamics with the housing market, which admittedly isn't going to drive because 28% of consumers have mortgages, but that's going to be a bloodbath at some point if rates stay at the current levels. But I just think I just don't think that we'll just glide into soft landing. Rates will be elevated, and I think we will see some distress.
Wait, just pause on that bloodbath for the UK housing market, because we've been reflecting on the fact that a lot of the UK data has shown to be more resilient than many had expected. Yes. But you're very concerned. You genuinely think there is a potential crisis brewing for UK real estate? Yeah, absolutely. I think it's the latent impact. So obviously, a lot of mortgages in the UK, unlike the US, are very short dated. So it's 2-year, sort of 3-year, 5-year. So there's a period of time before the rate increases start to have an impact. But if you'd refinanced your mortgage in lockdown, you'd have probably secured a rate at about 1%, 1.5%. If you're coming to refinance, that's now over 7%. So that's a 5- or 6-fold increase in your monthly payments. Now, people can run down savings because they increased their savings through lockdown, but that is going to be unsustainable for some people, particularly in London. We can see some of the huge mortgages people have on properties around here in the southeast. It's going to bite.
And pinpointing when that bites seems to be difficult. When do you think, Haig, and I don't know whether you want to focus on the mortgage dynamics or when the Bank of England cuts rates, when do you think this pinch point arrives?
I think it's probably sort of early to midway through next year. I mean, inevitably, the last thing people are going to stop paying is their mortgage. So you're going to cut expenditure and other things like holidays and so on before you do that. But of course, the property market is driven by marginal demand or marginal selling. And all it takes is 1 or 2 people to be forced into a sale at a 20% or a 30% discount that reprices everything else. So it's coming. It has to come if rates stay at the current level.
Okay, so from the negativity of the UK to your views on China, and you're constructive on China on a day. Well, you've been constructive on China for a couple of weeks, but Citi coming out revising their growth forecast for this country. What makes you constructive on China, and how do you want to get exposure to that?
Yeah, so been constructive in China for a while. I mean, obviously the Western press's view in China is usually quite negative. Because obviously not making decisions for the short term, they're trying to make decisions for the longer term. I think the key advantage that China has is they don't have an inflation problem. So if they want to cut rates or provide stimulus, they can do that because they're not constrained like we are in the West. And also, if they want to provide stimulus, they don't have to vote it through various committees. They can do it instantaneously. So they have levers they can pull. They're not constrained by inflation. And actually, if you look at it, and I know this is the thing we were discussing last time, actually the results for lots of Chinese companies have been positive. It's just not been rewarded in share price movement yet.
Yeah, and there are those debt worries, but that's for another day, perhaps.
Yes,
Haig, thanks very much. Thanks for joining us. Haig Bathgate, Head of Investments at Atomos Wealth. Coming up on the programme, job cuts at Barclays as part of its plan to trim headcount by around 300 people across the corporate and investment bank. We'll discuss next. This is Bloomberg.
You think New York is as safe as it was when you were in the government? It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase. Are you involved any longer in New York City matters, or your advisor? Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Markets today. Let's get an update on the financial services sector. Barclays is laying off roughly 50 senior deal makers as part of its annual staff cut. The cuts are said to be part of a plan to trim headcount by about 300 people across the corporate and investment bank divisions. That amounts to about 3% of total headcount in that unit, which also includes Barclays trading operations. Let's get more details from Bloomberg's Tom Metcalf, who's been following the story and can give us an update. What do you make of these cuts then, Tom? What's the driver?
Yeah, I mean, I think the interesting thing is this idea is 50 senior deal makers go in. I mean, these are the kind of cuts that are at least traditionally been pretty routine. You know, they go through, look to cull sort of the lowest or underperformers, as it were. But no, I think it's just another sign of just how difficult things are in the deal-making world. We've seen these cuts across Wall Street. And I think this is just the latest sign that, that market is not bouncing back.
Is there a risk they come to regret this, though? They loaded up on headcount during the pandemic with all that activity. Activity is going to come back at some point, and then they're losing some of their big deal makers. I mean, is the rationale for this well underpinned?
Yeah, I mean, I think that's the interesting thing. What we are seeing is some banks, namely Santander, for instance, they're still hiring. They're seeing this as an opportunity as more sort of deal makers hit the market. Hey, let's build up our franchise. I think they're coming from very different, positions, right? Santander trying to grow. Barclays pretty big, pretty embedded already. So I think the big players are kind of retrenching. But, some of the smaller rivals are perhaps seeing a bit of an opportunity.
And any sense of how this is spread across parts of investment banking? I remember speaking recently to some German investment bankers, different businesses actually, who are both talking about things on the IPO front, for example, looking a little brighter this sort of autumn than they had done during the summer when there was a lull. I mean, any sense of where these cuts fall then?
Yeah, there's definitely cuts in those areas. So ECM, obviously M&A, as you'd expect, but also in the trading side. So we don't have sort of the precise breakdown of how these 300 roles, it's X% in trade and X% in deal making, but it does seem to be fairly sort of widespread across all areas.
Okay, Bloomberg's Tom Metcalf from the finance team, leading the finance team here on those cuts coming through from Barclays. Coming up, it will be a hat-trick for the 2030 World Cup, with the tournament set to take place across 3 continents. That's for the first time ever. We're going to get more on that, what it means for the countries involved and what it might tell us about the potential hosts post that 2030 time frame. Currently, you're looking at European futures gaining just 0.2%. US futures, S&P E-minis down by 0.3%. And in your treasury markets, yields just edging up at the long end, 474 on the 10-year, just up 1 basis point. Gilts also selling off, yields up about 3 basis points across the curve. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today, 30 minutes into the European trading day. Let's get to your top stories. European stocks follow Wall Street into the green, while bonds take a sigh of relief, rallying in the most part after a soft ADP jobs report from the US. Oil prices stabilize after WTI sees its largest daily drop in a year amid fears of a slump in US demand. Plus, a show of unity. European leaders aim to show support for Ukraine at their summit today as the future of US aid to Ukraine hangs in the balance. We are live shortly in Grenada. So, Tom, a lot to think about when it comes to the European session, appetite for risk, given what we've seen in bond markets of late. We mentioned there the way that we've seen those yields coming down and that had driven some money into risk. That was certainly the theme through the Asia session. Yeah. In Europe, we look a little more confused, and certainly into the US session where futures are lower.
Well, that theme seems to be very short-lived. We logged on this morning, it was all about softer dollar, it was all about yields dropping, but that has changed. You're now seeing yields up across US Treasuries, you're seeing yields up, more pronounced, in fact, across gilts here in the UK, and we wait for that inflation expectations report out of the Bank of England around 9:30 UK time. So yes, there is a need, it seems, for additional catalysts and clarity for these markets. Maybe that will come through here in the UK with that inflation expectations report, but more importantly, the non-farm payrolls on Friday out of the United States to give us more clarity in terms of whether that softness is becoming more pronounced across the US labour market. You're seeing gains then across the benchmark of a little under 0.2%. The DAX down 14 points, off by about 0.1%, just holding above that 15,000 level. The FTSE 100, 7,417, just adding 5 points, up about 0.1%. And when you break down the sectors, it's some of the retail names like Tesco's that are lifting the FTSE 100 into positive territory. So let's change it on and see how those sectors are shaping up. Of course, the oil story, fascinating given that drop of about, 5% on the WTI yesterday on concerns about US demand and those inventories at Cushing edging up just a little bit. Again, so important when you're thinking about inflation expectations in terms of the forward look for oil prices. And remember that Citi came out with that call that actually you're going to get that down to $70 a barrel. But that debate in terms of where oil goes by the year end remains live. We don't have the sectors yet, it seems, but I can tell you that across the sectors, again, here in the UK, it was retail with Tesco's leading the top. Energy in focus for us, currently down 0.8%, despite the fact that Brent and WTI are picking up a little bit, so reflecting the pressure that came through yesterday on oil. Basic resources taking a hit, and you see the likes of Glencore and the FTSE 100, one of the leading losers so far in the session. Basic resources down 0.2%. Technology gaining 0.4%. And another sector to highlight for you, travel and leisure, which has been badly hit over concerns about higher rates. Travel and leisure in the session today currently adding 0.7%, Anna.
Right, let's leave the markets there for one moment and step away to another story then, Tom. The World Cup is coming to North Africa, it seems, for the first time, with Morocco set to host the 2030 event along with Portugal and Spain. But there will also be games in South America. If you're confused, Greg Tanner is here to explain. Bloomberg's Greg Tanner, an expert on football and usually resident for us in Dubai, but here for this week. Greg, very good to see you this morning. So how on earth, given all of those countries I just listed, all of those time zones, how on earth is this going to work?
It's complicated, and it's going to be a logistical nightmare, a lot of people are saying, given the distances and the time zones, etc. I think the fact that the event proper has been split over 3 countries, although it's unusual, it's not unprecedented. The 2002 was split between Japan and South Korea. The 2026 World Cup is going to be across the US, Canada and Mexico. So, you know, Morocco, Spain and Portugal getting it wasn't a surprise. What is a surprise is they've awarded the first 3 games to Uruguay, Argentina and Paraguay. The reason being, they wanted to host the event proper, but it's almost like they're tossing them a bone, a consolation prize. And Uruguay actually hosted the first ever World Cup exactly 100 years ago. So they're giving them that opening game to mark that, but they haven't got the event proper. But there will still be games, 3 games in South America before they then move it. So 6 countries, 3 continents.
Yeah, a logistical feat, as you say, and throwing a bone, a consolation prize for LATAM. It's going to be more than a consolation prize, arguably, for Saudi Arabia. You're based in the Middle East, you know this story, you follow the story, the Saudi money, of course, into all areas of sport, controversial and not. Are they really in line for hosting 4 years later, 2034?
It's not a foregone conclusion, but they're certainly a strong contender. It had been thought that they might actually put their hat in the ring for the 2030, for the one that's got awarded, in a joint effort with Egypt and Greece. They decided not to. But now that this has been awarded, FIFA are only going to take applications from Asia or Oceania. Saudi Arabia falls, within that region. And if you look at the sports investment, especially in football, soccer, that they've been making, it's clearly a priority for them. And they, so after the announcement came out of the awarding of Morocco, etc., last night, Saudi Arabia confirmed they will be bidding for the 2034 World Cup.
It is very interesting that they're spreading these things across various countries. As you point out, it's not unprecedented, but it is a bit unusual. But I suppose it's also understandable. The cost of these things is absolutely enormous. And if you want to allow countries that aren't just the richest countries in the world to host these sporting events, not just thinking of football here, I suppose, then perhaps this is something of a way forward.
Yeah, a way of spreading a load. In fact, we have an article on the terminal this morning looking at the disappointment of perhaps why some of the South American bids failed. And it was looking at Brazil in 2014 and how much they had to leverage themselves up and overspend. So, yeah, that could be an argument. Spreading the cost amongst countries takes all of the financial burden.
Greg, is it a clean process now, the bidding?
It's not for me to say. I couldn't possibly comment.
Well, they've been dogged, of course, by controversy FIFA in the past. Let's see if they cleaned up their act on some of these competitions. Greg, thank you very much indeed for walking us through how this is all shaping up. Really fascinating, and the potential for Saudi Arabia to host, in 2034. Right, coming up, German exports in August fell more than expected at 1.2% month on month. Are there more headwinds ahead for Europe's largest economy? We're going to be on the ground discussing next. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. and they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today, 39 minutes into a European equity session that is a little directionless this morning, up 0.1% overall, but looking at US futures that reflect higher yields once again on treasuries, and so those futures point a little lower. So E-minis down by 0.3%. Let's talk about what's going on geopolitically in Europe today then. Leaders from nearly 50 European nations will try to show unity in support of Ukraine at their meeting in Spain today. Meanwhile, US President Joe Biden has announced that he'll give a major speech about the importance of long-term support for Kyiv. Bloomberg's European correspondent Maria Tadeo is following the summit for us in Grenada in Spain. Very good to see you there, Maria. So how much cohesion, you're there on the ground in Grenada, how much cohesion is there in Europe when it comes to the long-term assistance that is being provided for this war-hit country?
Yes, Anna, and as you say, it's the European political community meeting that is taking place today. Just to remind everyone, of course, this is a new format that was launched last year. It goes beyond the European Union. This is about the European continent coming together around the table. We're actually expecting the UK Prime Minister will also participate here, and close neighbors of the EU. So that sets the scene for this meeting. It's close to 50 countries, and that is the symbolic nature of it. Now, in terms of the meeting today, I should say President Zelensky has arrived in Spain to participate in the meeting. It wasn't clear at the start of the week whether he would participate or not. In fact, at one point we were told that the Prime Minister of Ukraine would show up instead, but the President of Ukraine has decided to come to this meeting today and participate in person. There's one reason for it. We know that diplomatically this has been a difficult week for Ukraine. We saw that budget deal in the United States that left that tranche of Ukrainian aid out of the package. We also saw that meme from Elon Musk. I know we're a diplomatic summit, but behind the scenes, people do talk about this. It was that picture of a man who appeared to be sweating, asking for cash, and that man was supposed to be President Zelensky. What he wants out of the summit is a picture, and beyond the photograph, also a message that shows this country, despite the many difficulties, despite the fact that this is now a war that's going into almost 2 years, he's not alone.
Maria, how concerned, you have your finger on the pulse, of course, of European politics. You speak to people daily there in positions of influence. How concerned are they about the inability for the US Congress to get this additional financing through?
Look, they are, and they have been for a while. They have been for a while privately about the potential of the U.S. elections weighing into this debate, because for European Union leaders, the Biden doctrine is very easy to read. They know that weapons will come the way, and they know that funding will still be present, and obviously this is something Ukraine needs. I think what happened over the weekend really has served to accelerate some of those concerns. European leaders say, maybe not publicly yet, but definitely in private, and as I say, this will go going crescendo. The election in the United States can really change things, and then brings up the fundamental question, which is, if you do see U.S. politics becoming volatile, can the European Union make up potentially for that shortfall? And that means not just funding, but also weapons to go to Ukraine. So it is an issue that obviously they pay attention to. What I would say, however, this morning there is a lot of curiosity around that speech that President Biden announced yesterday. Remember, he said, quote, he would make a major speech about long-term funding for Ukraine. They want to see what's in that speech. And one particular line where he said maybe Congress may not approve of further aid, but we have other ways to keep aid going to Ukraine. That's something in particular the European leaders are curious about privately.
Yeah, it's going to be interesting to see what there are other levers that Biden can pull to get this aid to Ukraine. The mismatch there in terms of funding is remarkable. We had it up on the screen for about 42 billion euros from the US versus a little under 20 billion from Germany. So that gap is significant. Maria, today on the ground for us in Granada at that important conference, of course, of EU leaders, not just the Eurozone, but the UK as well. Now, Germany is heading for its full-year recession. First full-year recession since the pandemic. Europe's largest economy faces a number of long-term headwinds, including a dwindling workforce, a heavy reliance on China, and a painful energy transition, of course. It is an uphill battle for many companies, particularly for smaller ones. Bloomberg's Oliver Crook is in Berlin. Oliver, what did we learn then about the state of the Mittelstand? You've been speaking to business leaders there. You've been trying to gauge their sense of the direction of travel for this economy and just how much pressure they're under.
Absolutely, and we spoke to the chairman of the lobby group for the Mittelstand this morning, and just to remind people how significant the Mittelstand is in Germany, we call Germany the engine of Europe. The Mittelstand is really the engine of Germany. It accounts for something like 60% of all the jobs, 99.6% of all the companies in Germany, and a third of all the sales that are done in Germany. So really, this is a key part of the economy, but it's hard to know how as a whole it's doing because there's so many of these small companies. So their biggest concerns right now are the labor shortage, its energy costs, and its bureaucracy. Labor shortage is a problem across the board. For energy costs, a lot of these companies do not have the same kind of resources as the big giants out of Germany. And really for them, adapting, there's a question about whether these small energy-intensive companies will continue to exist in Germany. So I asked him about that, and he was saying that really they need to adapt kind of where they're adding value in the economy. For bureaucracy, it's the same question. These companies do not have the huge back house to deal with all the bureaucracies from, yes, Germany, from the EU, and this is an issue that has been massive in Germany for a very long time, and very little has happened on it. I also asked him if Germany is the sick man of Europe. This is sort of the big question in the mainstream of the economy. He said no, but they really need to do everything that they can right now to not become so.
Okay, let's just break into our coverage of this important story, just to bring viewers up to date, Oliver, on what's going on with Alstom. This, of course, a French transportation train maker. Alstom shares dropping 31% as they start trading, 32% lower as they start trading this morning. The rail equipment maker seeing negative full-year free cash flow. The company saying it's more optimistic for the second part of its fiscal year, but the slashing of its full-year free cash flow forecast clearly taking its toll on the stock today. It's taken this long to open up this morning. It had a trading halt, but we did see from pre-trading indicators that it was going to be fairly heavily sold off this morning. It's seen a jump in inventory, a delay to a number of programs, and lower than expected orders in the first half. So there we are. That's the Alstom story. Oliver, back to you on the German front. On China, de-risking. This is, of course, the key word, not decoupling, but de-risking with China. I heard a lot about it when I was in Germany just recently. How is Germany going about this?
Yeah, so Germany was one of the greatest, if not the greatest, benefactors of globalization, getting their products and their expertise out all around the world. And we see, as you know, the industrial landscape is shifting, that is really changing. And a lot of these Mittelstand companies have gone into China and actually were encouraged to go into China and build those kinds of relationships through the years. And their supply lines run through it, and many of their customers run through it. And it's been an absolute huge part of the wealth creation story in Germany and even for these companies. So I spoke to the chairman of the Mittelstand lobby about this and how hard it is for these companies to deal with that new reality.
This is much more difficult for the small and medium-sized companies to change their supply chains very quickly, but there's also a chance. When we have in our discussions with company leaders, they talk together and find, you make these parts, special parts, what I need, and I don't have to buy it in China. So we have a little deglobalization in the European market maybe as a result of this.
So really highlighting some of the benefits of the Mittelstand, how nimble they are, how quickly they can adapt, and they're not encumbered by a lot of the same things that the big companies are. But when you survey the Mittelstand, these companies, they're really dead split down the middle about whether they should be exposing more to China or less. It's 15% in either direction and falling to net zero. So it's really a very active debate for the medium-sized companies here in Germany.
Okay, great reporting. Bloomberg's Germany correspondent Oliver Crook on the ground for us on the challenges for the Mittelstand. Now, to UK politics, and the Prime Minister here, Rishi Sunak, has attempted to position himself as the agent of change in his first speech to the Conservative Party conference as leader. Bloomberg's Lizzie Burden reports from the conference in Manchester.
Rishi Sunak has just wrapped up 4 days of Conservative Party conference here in Manchester with perhaps the most important political speech of his career so far. With an election on the horizon, he tried to present himself as the change candidate against 30 years of status quo, despite the fact that the Conservatives have been in power for almost half that. But this was Operation Rebrand Rishi. He cancelled the northern leg of HS2, the high-speed rail network, to Manchester, but instead he promised £36 billion of reinvestment in travel infrastructure in the North and the Midlands. He also introduced a graduated smoking ban that echoes New Zealand's, but he resisted 4 days of pressure to announce tax cuts, and he stuck to his commitment to halve inflation by the end of the year. That, he says, is the best way to help people through the cost of living crisis. He says he's the Prime Minister who takes long-term decisions for a brighter future. But will these policies cut through beyond these conference hall walls? Only the polls will tell. Lizzie Burden, Bloomberg News in Manchester.
Okay, coming up, are we going to see a turning point after the bond market wrap? But before we do that, let's just reflect on that point by Lizzie. The rebrand Rishi objectives of this Conservative Party, the divisions within that party, and whether or not actually this speech and this event will change a lot as we look ahead to Labour.
Yeah, absolutely. So Labour coming up, and they're trying to recast the Tory party then as the Change Party, because they realise after 13 years that seems to be in their interest to do so. It's all about the polls, isn't it? It's going to be very much about the polls and whether this is going to work to close the gap. So they're still sitting on this big gap between them and the Labour Party. As we were hearing from our colleague Joe Mays earlier on, they did see the Tories saw a bit of a pop in the polls, a bit of a closing of the gap on the back of that the pivot on their green policy, but whether that sustains is well, it's not yet.
And the focus now and the scrutiny on Keir Starmer, of course, and the Labour Party as they gear up for their event as well. We're going to have plenty more next in terms of what is driving these markets as we get to a point where there's a lack of conviction around the move into treasuries and into debt yesterday. Of course, that data, softer data out of the US, changing the scoreboard for some at least. Currently, you're looking at European equities just holding on to very slim gains of about 0.1%. And yields are up again across the Treasury curve, apart from the 2-year. And the 2-year here in the UK, the gilt's 4.95, currently yields up 2 basis points. Plenty more in terms of the analysis. Stay with us. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today, 8:53 here in London, so 9:53 in Paris, Berlin. Fairly flat across European equity markets as we digest a mixed picture on treasuries this morning. Look at US futures that are a little weaker this morning, down 0.3% there. Let's talk about what's happening in the markets. Bloomberg's Valerie Teitel joins us on set, and we were going to ask you if this is the start of a big reversal in bond markets, Valerie, but that question probably would have been more relevant an hour or two ago. Now we have a sort of mixed picture on treasuries. What do you make of it?
No, that's right, Anna. It's been a fast-moving market in treasuries. It was a bit of relief to come in this morning and finally see a rally on the board, but we're seeing 30-year yields starting to tick a bit higher, and that's getting my mind worried about today's session. We do have jobless claims later today. We have gotten such a mixed picture on the labor market this week. JOLTS coming in strong, ADP coming in weak, and with jobless claims, maybe the market will overreact to any signal we get from that. We know that jobless claims have come in below expectations for 7 weeks running, so another hot jobless claims can maybe spark this bond route maybe a bit further, but the big attention really does go to Friday and what the NFP does tell us.
And one of the top read stories of the day on the Bloomberg is related to this Barclays note around, and basically making the point that there is no level, there is no sweet spot for yields that is going to conclusively draw money in and reverse the trend. What they say is needed, or will have to happen, is a sharp sell-off in equities in order to get a convincing move back into bonds.
Yeah, maybe telling us just how bearish Barclays is on the Treasury market if they think that we need a big risk asset repricing in order to get a sustainable bond rally back on the board. But again, that comment from Barclays was really interesting, that they said that there's no magic level of yields that will entice these buyers back in. It's going to need to be a risk-off move. But to me, I mean, I'm less bearish than that. I think all we need is a weak payroll print tomorrow to set the tone maybe for the few trading days ahead, for the week ahead for the Treasury market. A weak payroll print, a soft payroll print could spur some buying back into the bond market and maybe end this Treasury route for now. But it's really concerning to go into this Friday print without the bond market having settled yet this week. Yes. And I think that's going to keep the market nervous.
I suppose if you are nervous about everything we're seeing in bond markets, maybe you take some solace from the fact that oil prices didn't ever get to $100 a barrel. I mean, not yet anyway, not in this particular few weeks where we've been very focused on it. We saw a pullback on that yesterday, driven by demand concerns rather than supply this time around, which reminds us that there are perhaps downside forces still operating on inflation. And if the bond route was all about worries about how high inflation stays, then this is relevant.
Yeah, it was relevant yesterday across the commodity sphere. Bloomberg Commodity Index having its worst day since March earlier this year during the banking crisis, and that with that WTI future falling over 5% on the day. It's really true, though. The narrative did shift yesterday from worries about supply to now worries about demand. We saw stockpiles rebounding for the first time in 7 weeks at that key Oklahoma hub, and worries about this yields moving higher, possibly denting global demand, really weighing on the commodity.
Valerie Teitel bringing the analysis for us. As we look at that 30-year then in the US, 488 moved higher in yields by 2 basis points. European futures just holding on to gains of 0.1%, but US futures pointing lower. That is it for markets today. Plenty more coming up. This is Bloomberg.
product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Important security message. Your computer has been locked up. Your IP address was used without your knowledge or consent to visit websites that contains identity theft virus. To unlock the computer, please call support immediately. Please do not attempt to shut down or restart your computer. Doing that may lead to data loss and identity theft. The computer lock is aimed to stop illegal activity.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The bond sell-off takes a breather after a bruising few days, giving some relief to markets.
Your IP address was used without your knowledge or consent to visit websites that contains identity theft
the
virus.
largest daily drop in a year amid fears of a
please
slump in
call
U.S.
support
demand.
immediately.
Plus, coming up on
Please do
Bloomberg
not
UK,
attempt to shut down or restart your computer.
The Prime Minister rips up the
Doing that may
country's
lead to data
flagship
loss
rail
and
project,
identity theft.
taking aim at the record.
The computer lock is aimed to stop illegal activity.
Now, good morning, everyone. We have
Please
definitely
call
a
our
packed show.
support
Let's take a look
immediately.
at what's going on with
Important
European markets.
security
Now,
message.
it has been a wild ride.
Your
When
computer
you look
has
at
been
markets
locked
over the
up.
last 5 days, European
Your
shares
IP address
at the
was
moment
used without
creeping
your
higher
knowledge or
a little
consent
bit,
to visit
practically unchanged
websites
for a lot
that
of the main
contains identity theft
benchmarks.
virus.
We did have 3 straight days
To unlock the
of
computer,
losses.
please call
We had some
support
softer
immediately.
U.S. economic data yesterday,
Please
which
do
really
not
sparked
attempt
a
to
late
shut
bounce
down
on
or
Wall
restart
Street
your computer.
and seemed to soothe
Doing
fears
that may lead
of
to
a Federal
data loss
Reserve
and
interest
identity
rate
theft.
hike next month. Now,
The
the relief
computer lock is
yesterday
aimed
came
to stop
after there
illegal
was data showing
activity.
that U.S. companies added
Please
the fewest
call our
jobs last
support
month
immediately.
since early 2021.
Important security
But if you look
message.
at what the U.S. 10-year yield
computer
has been
has
doing
been
over the
locked
last
up.
5 days, look, markets,
Your
I think, are
IP
still
address
struggling
was used without
to gain
your knowledge
traction
or
after this
consent to
bruising
visit
cross-asset
websites that
sell-off
contains
that
identity
wiped
theft
trillions
virus.
off
To unlock
global
the
equities
computer,
and bonds
please
amid
call
this
support
uncertainty over
immediately.
how much higher U.S.
Please
interest
do
rates
not attempt to
could
shut
go
down
from
or
the current
restart your
22-year
computer. Doing
highs,
that
and
may
that's
lead to data
the
loss and
picture of the
identity
U.S.
theft.
10-year yield over the
The
last
computer
5
lock
days.
is
A
aimed
couple
to
of other
stop
things we need to
illegal
watch out.
activity.
I think Alstom,
Please call
one
our
of
support
the ones that
immediately.
are moving the most, I
Important
have to say,
security
bonds
message.
due in 2029
Your
are dropping
computer
the
has
most
been locked up.
on record. Now, for
Your
more
IP
on the
address
markets, let's
was
get
used
straight
without
to
your
Bloomberg's
knowledge or
Valerie
consent to
Teitel,
visit
who joins
websites
us with
that
the latest.
contains
Valerie, what you
identity
got?
theft virus.
It's a fast-moving market
unlock
this
the
morning in the
computer,
Treasury
please call
market. We
support
did walk in
immediately.
this morning seeing a bond
Please
rally
do
across
not
the
attempt
screen,
to shut down
but
or
now
restart
it's slightly
your
more
computer.
mixed, and my eye
Doing
goes
that may
straight to
lead
the
to data
weakness that
loss
we're
and
still
identity
seeing in the
theft.
long end. Those long end
The
yields
computer
are
lock is
rising
aimed to
2
stop
basis
illegal
points. But
activity.
let's take a look about how
Please call
the
our
bond
support
rally
immediately.
was sustained
Important
yesterday.
security
In my next
message.
graphic, we're quite off
computer
the
has been
highs
locked
when it
up.
comes to the 10-year yield.
Your IP
Nearly
address
15
was used
basis
without
points
your
off the
knowledge
highs
or
that we
consent to
reached
visit
at some point
websites that
yesterday.
contains identity
But
theft
that
virus.
goes to show that this has been a
To unlock the
historic
computer, please
drawdown
call
in
support
long-term
immediately.
treasuries. If
Please
we
do
flip
not
on and
attempt to shut
look at my
down or
BTV,
restart
you
your
can see
computer.
that the
Doing that may lead
long-term
to data loss and
treasury
identity
index
theft.
that Bloomberg holds
The
is
computer
down
lock is
nearly
aimed to stop illegal
50%
activity.
from the peak. And this is
Please
important,
call our
Francine,
support immediately.
because we can compare it to what happened
Important
during the
security
dot-com
message.
bust, for example.
Your
During the
computer has been
dot-com
locked
bust,
up.
equities were down
Your IP address was used
49%
without your
after that,
knowledge
and
or
we're seeing
consent to visit
quite an
websites
historic
that
meltdown when
contains
it comes to the
identity
bond
theft
market as
virus.
well.
Valerie,
To
thanks so
unlock
much.
the
Valerie
computer,
Titel
please
there with
call
the very
support
latest on some of this
immediately.
meltdown. Now, joining us is Joanna Kirkland, Chief Investment Officer and Global Head of Multi-Asset Investments at Schroders. Joanna, what a week to come in. I mean, I feel like everything and anything has happened in between. The underlying, I guess, assessment so far is that we're going to see a lot more volatility, or you think things will come down from now?
No, I think that we still have some challenges. I think that basically the sort of the sell-off at the long end of the curve is really driven by the fact that at the moment nobody's expecting a recession in the States. To justify the pricing and the inversion of the yield curve, that's what you need to see. So while we're seeing good news on inflation, which is supportive of the front end, I think ultimately the Fed is plateauing here. There's still, as I said, the pricing of the long end is still problematic, so probably a bit more work to do. But, you know, all in all, I think eventually things will settle down.
But if you look at the week that was, were you surprised as how quickly fear can grip the markets? I know there's been perils to .com. I know there's been perils to some of the other bouts of volatility that we've seen. And it's unclear the catalyst of what that was and what that means for the next 6 months.
It reminds me, I mean, it does remind me of that period of time back then when we had the bursting of the .com bubble. Ultimately, there were some fundamental assumptions that had to be revisited. And the same has happened with the bond market. Big picture, we think we are in an environment where there's been a deterioration in the growth and inflation trade-off. You know, ultimately, we think that new ranges are required for bonds. And the last 2 years have really been about bond investors getting used to that fact and accepting that we're not going back to what was true the last 10 years. So whenever these fundamental assumptions get challenged, you know, it takes a while for markets to adjust. And that's why, obviously, we're seeing this bear market in bonds. The exact timing of it then varies. But yes, I mean, I think it's fairly typical of, as I said, ultimately a fundamental reevaluation of what the right level of long-term rates is and ultimately what that means for bond markets in general.
So, Jenna, how do you build a portfolio then? What are you constructive on at the moment?
Well, actually, I mean, I think there's still a role for bonds, but as a source of yield. I think that, you know, I was hearing earlier on your show that there's talk of the fact that for bonds to rally, you need equities to sell off. That's assuming that negative correlation that, again, we saw in the last decade works. Again, I think
assumption.
That's a massive assumption right there. I don't think we could buy bonds for their correlation benefits anymore, but the good news is they are providing yield, and that income in itself, in terms of its payoff, is diversifying. So, again, when 60-40 was invented, the classic balance fund, by the way, the correlation between bonds and equities back then was positive. So we're going back to the old reason for owning bonds, which is for income.
Is this, you know, across, I know there's different maturities, but is it, you know, how much different is it if you own gilts compared to treasuries?
Ultimately, it's about the maths of the curve. So, you know, the kind of areas we like the front end of the US curve, but not the long end, because, again, you still have to pay to own it. It's negative carry. We like European investment grade debt because the spread there helps to stabilize, buys you time. I think gilts is still a challenge because ultimately, you know, again, that deterioration between the growth and inflation trade-off is particularly bad in the UK.
What does that mean, Joanna, for when do you actually think that we'll start cutting rates, that the Fed will start doing that? And that, you know, how much does that change the regime?
Well, I think, again, within the bigger shift in markets, you'll still get rate cycles. Eventually, the Fed will cut rates. But for now, based on our expectations that we're not getting a recession, and in particular the fact that government spending, the taps are still staying firmly on, particularly going into an election year, you know, we agree with what's priced into the market, that the Fed is likely to stay on hold for quite a while. So again, investors have tried to price this Fed pivot so many times, started in the summer 2021, tried it again in 2022. The Fed has actually been very consistent in saying they're in no rush to cut rates, so maybe we should just listen to what they're saying.
Joanna, overall, when you look at some of the equity earnings that we're expecting, how much will that dictate where you see value? I know there's been a sell-off in tech and certain parts of the markets right now.
Well, ultimately, if inflation continues, I mean, ultimately, the statistics are supporting this idea that the Fed is probably done. That should take some relief off bonds, ultimately can support tech valuations. I think the style argument is quite difficult in this environment. There's many cross currents. I think the thing to focus on within equities is more the different regional trends. We're seeing unprecedented divergence, actually, across the regions this year. We haven't seen that for a long time. In a world of zero rates, everything moved together. While now we're seeing, obviously, Japan doing very well, Europe struggling. Those are where we're seeing the opportunities on region rather than sector or style.
Joanna, thank you so much. Joanna Kirkland there from Schroders stays with us, and we'll talk a lot more about some of the regions they're interested in. Now, Alstom plunging after the train maker slashed its free cash flow forecast following a delay on a contract inherited from the troubled Bombardier acquisition and a steep rise in inventories. Now, we'll have plenty more, of course, on Alstom. Also, Amazon and Microsoft's cloud services face an investigation by the UK antitrust watchdog over concerns that the US firms may be abusing their market powers. Now, communication regulator Ofcom has officially asked the Competition and Markets Authority to conduct a formal probe. That's after its own study found evidence that Amazon and Microsoft made it hard for customers to use multiple services or switch suppliers. Coming up, we have a lot more on the markets. We continue the market conversation, including the easing of the bond sell-off after bruising 3 days. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Now, oil clawing back a little ground today after signs of weaker demand, sparking the steepest one-day drop in WTI in more than a year. Now, for more on all of this, let's get straight to Bloomberg's Anthony DePaula in Dubai. Anthony, good morning. So what does that say actually about the market's reaction to U.S. data versus OPEC's Plus decision to keep output cuts in place?
Good morning, Francine. Yeah, what we saw yesterday was really the market reacting to that new data coming out of the U.S. What we saw was some really weakening signs of gasoline demand there, and an inching up in some of the crude storage numbers for Cushing, which is one of the most widely watched commercial storage areas. That's really what influences the market as gasoline demand looks a little bit weaker there. That potentially impacts how much the refineries are wanting to buy, and so that's a bad sign kind of coming out of this period that was the summer driving season in the United States. So we're supposed to be coming into a slower season anyway, but that's kind of a bad sign, and that's been contradicted with OPEC's news. That's on the supply side. They're keeping in place their production cuts and their quotas at the moment. The market was expecting that. They'd already said that those cuts would stay in place until the end of the year, but potentially we could have gotten some kind of revision or some kind of language change. We didn't get that, so the market really reacted to that kind of negative viewpoint out of the U.S., and that's why we saw that drop yesterday, Francine.
So, Anthony, what does that mean for where you see the price of oil going? I know when you speak to top investors, they always say, look, you need to predict between 70 and 150, which is of no use to anyone. But is $100 now out of the equation?
Yeah, $100 was the talk of the town just a week ago when we were, around the 95 area, and now we've come down almost $10 within a week. That was really based on a lot of supply constraints there. And last week we saw some really tight numbers on the Cushing oil supply in the United States. So we see how much a week can change things. But we are looking at, as I said, those OPEC cuts continuing through the rest of the year. OPEC is really targeting the commercial inventories, trying to take oil off the market by undersupplying the market. So as long as the demand does continue, we should see some continuing tightening throughout the rest of the year. Now, of course, we were at a big oil conference in Abu Dhabi this week, talking with a lot of producers and consumers. We saw comments from the Indian oil minister saying that they wanted to see oil around $80 as a fair price. The NECO was saying that he saw an average of about 82, 83. Well, it just happens that 82 is the average that we've got so far. So we'll see, whether we do get those peaks up to 100 as demand does increase and the Saudis and the Russians keep that oil supply restricted towards the end of the year, or if we average out at a lower level, Francine.
Anthony, thank you so much. Anthony DiPaolo there with the very latest on oil. Our big number, it's a good big number, Anthony. So I know you know it by heart. It's tattooed to your brain, but everyone else should also have a look. This is the U.S. seasonal gasoline demand slumping to the lowest level since 1998. That's 25 years. Anthony will have plenty more on OPEC and oil throughout the day. Now, still with us, Joanna Kirkland, Chief Investment Officer and Global Head of Multi-Asset Investments at Schroders. I mean, it's an absolute nightmare, Joanna, trying to figure out what oil is, right? Yes. Because it's so unpredictable in many ways. What do you use for your base forecast that also filters through inflation?
Well, generally, again, I mean, oil and commodities more broadly, going back to our conversation just now, quite an interesting allocation in a way that they weren't in the last decade. So generally, we've been dipping in and out over the last couple of years. Quite a good geopolitical hedge, good hedge against inflation. Our assumption is, yes, you're seeing those higher oil prices started to bite in terms of gasoline demand, so we're seeing that fall. But ultimately, this sort of chronic undersupply is something we think continues for a while. So, generally, we're still fairly positive on commodities. We see them as a diversifying investment, and oil is quite an important part of that. And that sort of higher rates and oil, I think, ultimately does bite into U.S. consumer demand. So we do think things will slow as a consequence.
And Joanna, tactically, how much do you look at sectors and earnings specific, or how much is it regionally? I know a lot of the companies, for example, the FTSE companies are very international. A lot of them are very commodity rich. But what do you do with Japan equities right now, for example?
Well, again, I mean, we're seeing these diverging rate cycles, which we haven't seen in a long time. We like Japan because ultimately the Bank of Japan is keeping things very loose compared to the rest of the world, so it's still a market that we like owning. And on the other hand, I think in Europe we're seeing that slowdown coming much more meaningfully, so it's an area that generally we've been avoiding. The UK is an interesting market. As you say, from a sectoral perspective, it was out of favour for so long. Actually, these days, the sectoral composition is more interesting in an environment of, potentially higher commodity prices. It has a defensive bent to it. A weaker sterling is helpful for FTSE earnings. So, I think it's fashionable to be very negative on the UK. I'd say there are some positive things to say about the FTSE right now.
Actually, we have a podcast, and we spoke to the boss of the LSE, and she was extremely optimistic. And she was saying, we've just been too pessimistic.
Yes.
And I don't know whether at some point you have to hit bottom, and so you go back up, or there's just been a perception that the UK has been oversold when, in fact, it had pretty strong fundamentals.
The fundamentals have always been okay. As I said, it was so out of favour, particularly when we had a very tech-driven market. We lack tech in the UK index. But as I said, the sectoral composition is becoming less of a challenge for it now.
Joanna, when you look at Europe, so it's been, in terms of valuations, they look pretty cheap to a lot of other parts of the world. Is there anything that you like in Europe particularly?
No, I think the challenge with Europe is that, domestic growth is still fairly sluggish if you look at the rest of the world. And at the same time, quite reliant on Chinese demand in some areas. There's a lot of talk of Germany right now. So right now, it's not an area that we've been favouring.
How do you play China?
Well, China, again, is an area where people have got very, very pessimistic on China. And, ultimately, we think that growth is likely to remain sluggish there. But arguably, that is starting to get reflected in market valuations. So generally, having been a bit underweight China we've been moving back to neutral. From a top-down allocation, though, we need to be very careful about China. It's a very idiosyncratic market, really for active stock pickers only.
Joanna, thank you so much. A great pleasure to have you here on The Pulse. Joanna Kirkland, their Chief Investment Officer and Head of Multi-Asset Investing at Schroders. Coming up, a show of unity for Ukraine. European leaders gather for a summit today as the future of U.S. aid for the war hangs in the balance. We're live in Granada with the latest. That's next, and this is Bloomberg.
Is as safe as it was when you were in the government? It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
They can buy or rent apartments at crazy prices, and this is pushing up the cost of housing. Second, sometimes these billionaires do not live, the idea of community, so they are happy. They live in a very vibrant city, and an easy city because it is not so big, but we would like to have a sort of give back from them. On the opposite, we have the university students who have difficulties to find affordable apartments.
Well, that was the mayor of Milan, Giuseppe Sala, speaking to Bloomberg. Now, Ukraine's President Volodymyr Zelensky has arrived in Grenada, where European leaders are gathering for a meeting expected to show unity in support of Kyiv. Meanwhile, U.S. President Joe Biden has announced he'll give a major speech about the importance of long-term backing for Ukraine. Well, Bloomberg's European correspondent Maria Tadeo is following the summit. Maria, great to have you on the program today. So Zelensky has arrived there. What's he looking for?
Yes, Francine, and he is here because it wasn't always clear. Remember, at the start of the week, it was suggested that Zelensky would not attend the summit, and instead it would be the Ukrainian prime minister who would sit in for him. Today, manifestly, he's changed his mind and decided to participate in the summit. And Francine, you can see the logic for the Ukrainians. This has been a difficult week for Ukraine. We know, obviously, the United States decided to opt out of an assistance package in the shutdown deal. We also know, and this may seem trivial, but it really has made the rounds behind the scenes. There was that tweet, that X post by Elon Musk, which presented a man who was sweating, asking for cash. He was supposed to be President Zelensky. That has created a lot of fury internally in Ukraine. So by being here, there's two things that, of course, President Zelensky wants. One is that picture, that photograph of leaders. There are more than 50, almost 50 countries gathered here to show that he is not alone, that Ukraine is not alone, but there's also the political significance of this. He's going to have a number of bilateral meetings with a number of leaders, the Commission. Emmanuel Macron, the UK Prime Minister, is also expected to attend the summit. A lot of that has to do with further assistance to Ukraine, but also politically. Let's remember that Ukraine aspires to join the European Union, and the Commission is expected to put out an opinion as to whether or not the country is ready for open talks. That's another issue that he wants to talk about, but fundamentally, it is also about the visuals. He wants to show that here he is united by the international community, and he's not alone, despite the many difficulties he's had this week.
So, Maria, how much fear is there that U.S. support is actually waning or going to wane even more into the election year?
Yes, and Francine, that is really the tension point. And we know it has been privately, maybe not so much publicly, but it has been privately among European leaders, because so far the Biden doctrine is very easy to read for them. It's yes to the weapons and yes to money to Ukraine, stand with Ukraine, and it is unconditional. But obviously now they see, and they see it very clearly after the shutdown deal, to leave that aid aside, that this is an election year, that it is volatile, and that that kind of aid may become difficult. What I would say, however, is that this morning there is a lot of curiosity about that announcement that President Biden made yesterday. He said, quote, he's going to make a major speech about the need to keep the long-term funding for Ukraine. But there's one particular line that really has gathered a lot of attention here, which is President Biden saying, even if Congress does not approve of further aid, there are other ways the United States could continue to keep that, although he did not specify. That is one issue where the European Union would like to see clarity, because then that takes us to the fundamental question. If some of that support is decreased by the United Nations, or excuse me, the United States, will the European Union make up for the shortfall?
Maria, thanks so much. Maria Tadeo, their European correspondent, of course, on the ground for us, following all of the latest developments. Now, in corporate news, Barclays is also dismissing roughly 50 senior deal makers as part of its annual staff cut. The layoffs are said to be part of a plan to trim headcount by about 300 people across the corporate and investment bank divisions. Now, that amount is about 3% of total headcount in the unit, which also includes Barclays' trading operations. Coming up, Rishi Sunak tries to rebrand his administration and effectively fires a starting gun on a new electoral campaign. We'll unpick all of the key details in our special UK show. That's next, and this is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services and markets. I'm Francine Lacqua here in London. Now, the UK Prime Minister Rishi Sunak has attempted to position himself as the agent of change in his first speech to the Conservative Party conference as leader. Now, the attempt to reframe his administration reflects both the 20-point deficit to the opposition Labour Party in opinion polls and the lack of time to turn it around before the next general election. Well, Sunak took aim at the records of previous Conservative prime ministers, some of whom he served under as he announced a raft of new policies. Now, the most controversial headline, of course, was his decision to scrap the second part of the high-speed rail project, HS2.
I am ending this long-running saga. I am cancelling the rest of the HS2 project. And in its place, we will reinvest every single penny, £36 billion, in hundreds of new transport projects in the North and the Midlands across the country. This means £36 billion of investment in the projects that will make a real difference across our nation.
Let's discuss with Bloomberg's Caroline Hebker and Joe Mays. Both were at the party conference. Joe is still in Manchester. I don't know how you got back, Caroline, because it was actually quite hard because of the train strike as well. So you were in Manchester 4 days, both of you. There's been quite a lot of reaction on actually HS2 and whether, does that help with the polls longer term?
Well, this is the big question. Reinvesting the money in road and rail projects, that was the pitch that the Prime Minister made to the party faithful, the grassroots who were gathered for this major jamboree. It's an annual event. The Prime Minister confirmed what had hung over this whole conference was high-speed rail to the biggest rail infrastructure project that the UK has seen in decades. He did say that he would cancel it, and he used that word. The reaction, though, particularly from Manchester and the Labour Manchester mayor, has been harsh. Extremely frustrated and disappointed that this high-speed bullet train basically up to the city where the conference was taking place is not going to now happen, and saying that it really weakens the credentials that the Conservative Party have for being the party of business. And also they're very dubious about whether the money would be reinvested or exactly how it would be reinvested in road and rail projects in the North and the Midlands. So I was speaking to Andy Burnham, the Manchester mayor. He gave a press conference after the Prime Minister spoke at party conference. This is what Andy Burnham had to say.
It never helps anybody when a country rips up plans that have been worked on for a long time, because businesses then look at that and think, God, we need more stability than that. So I don't understand how the Conservative Party, which once called itself the party of business, can look at its own behaviour this week and think that's consistent with a party that's about bringing growth to the regions or investment to the regions.
So that was Andy Burnham, the Greater Manchester Mayor, speaking to me only yesterday. I did ask him whether he wanted the Labour Party to recommit to HS2 were they to win in the next general election, which we know has to take place basically next year. He wasn't boxing them in to that, but he was frustrated, along with the chair of the Manchester Business Board, Lou Cordwell, who also spoke to me yesterday. They were frustrated that there was no engagement from the Prime Minister or his team, that they were there in the city. They could have collaborated. They were trying to paint themselves as very reasonable with the collaboration of a lot of business leaders in that city, saying we were here in the same rooms, we could have had that discussion, and we didn't, and they were very angry about that.
And Joe, what did you make of, in general, so I've heard from various quarters that actually it was a little bit different this time, that you didn't have the kind of the wow factor that we've seen at previous party conferences, that in terms of policy there was quite a lot because they're fighting now for the next election, but at the same time it maybe wasn't as colourful as in the past.
Yeah, there was a consensus that it was rather flat in Manchester, no real major excitement in the main hall. I mean, if anything, the most drama was coming on a few of the fringe events where you had former Prime Minister Liz Truss holding a growth rally attended by the likes of Nigel Farage, for example. That created a bit of a buzz, but broadly speaking, it felt like a party that knew and knows that it is well behind in the polls, needs to do something about it, and is struggling. And I think that permeated throughout the conference. There was a slightly dour feel to it all, and Rishi trying to reinvigorate matters with this big pivot on HS2, the pivot on the green agenda, but the polls haven't really moved in the way they would want, and so yeah, slightly dour.
But so, do you think that now everything we're going to hear from the Prime Minister and the government is just to win votes? So are we going to see actually more 180-degree turns on certain things, like we heard, for example, on climate change, because they're looking at the numbers or looking at the polls and they'll do anything to try and get ahead?
I think that's exactly how to think about what this Prime Minister is currently doing. Him and his core team, they look at those polls and they think, look, we're going to be out of power in a year's time unless something changes, so we have to do something. It's a backs against the wall moment, effectively, for Rishi, and that's why we've seen the green agenda pivot. We now have this HS2 move as well. Him and his team are saying there will be more like this in the coming weeks and months. We have an autumn statement coming up from Jeremy Hunt in November, so that could be another opportunity to do things. They've got announcements planned on things like improving the electricity grid, that there's potential moves on things like inheritance tax coming down the line, looking for potential tax cuts in the spring budget. So there are plenty of opportunities to do more like this, create dividing lines with Labour, try and have a sell to the public, because if you don't do that, he's likely going to lose the next election.
Yeah. So, Caroline, what did we learn in terms of how he's going to do this and what the key points that he wants to focus on?
I think the remarkable thing is that Rishi Sunak is not running on the 13-year history of the Tory government or any of its achievements. He was talking about fundamentally changing Britain. I think that raised some eyebrows, frankly, in the room, of party faithful that were there yesterday. He kept referring to the past 30 years, which therefore includes the last Labour government. I think that, as Joe says, there is a realisation that the party is quite behind in the polls. There were some good moments. For example, the Prime Minister's wife who introduced him, that was seen as perhaps potentially quite an asset for him. Penny Mordaunt also gave a real kind of barnstorming speech. She really did seem to try to rally people to the fight, and she kept talking about fighting, and if you fight, then the person next to you energy fights. So they understand that it's going to...
I heard that speech. I mean, it's quite tough. There's a lot of fighting
and a lot of more references. So I think that really you understood from that speech just how keen and perhaps even desperate the party is to that they have to deal with the lag behind the Labour Party. And of course, the Labour Party will get the last word because their conference starts on Sunday.
Yeah, I'm really looking forward actually to the coverage. It's been superb from all of the Bloomberg team. Caroline, thank you so much. Caroline Hepker and Joe Mays. Now, coming up, we're joined by Kelly Beaver, the Chief Executive of Ipsos UK, as we take a look at national polling in the midst of the party conference season. This is Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
This is Bloomberg.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Person who would be game-changing in terms of unlocking that value for the UK company, or unlocking that market, would have to be paid more than the CEO and wouldn't be able to have any performance-related pay on top of what they started at, and is probably still taking a pay cut from what they'd be paid to work for an Asian company or a US company or even sometimes a European company.
That was the Chief Executive of the London Stock Exchange, Julia Hoggett, warning that the UK's restriction on executive pay are hindering companies' efforts to recruit top talent after Brexit. Now, you can listen to that full interview. She was on fire. It was a great interview, a great listen on Bloomberg's In the City podcast that I host along David Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. Now, I would also be very grateful if you rate and review it, and that new episode dropped this morning. Now, let's return to politics and what it all means for polling. According to the latest data from Ipsos, listen to this, nearly 9 in 10 Britons believe that Britain needs a fresh team of leaders. Now, for more on this, we're joined by Kelly Beaver, Chief Executive of Ipsos UK. Kelly, thank you for joining us. I mean, you understand, I love it's so hard actually asking people questions that make sense of the mood of the country. What at the moment is the most surprising thing when you speak to people about leadership, about their politicians, and about the Conservatives?
Well, unfortunately, there's nothing surprising when we look at the data. We are seeing a really declinism attitude amongst the British population. 7 in 10 think that the country is in a worse place to live than it was 10 years ago. And we're seeing, as you say, the change in leader point really being something that the public is very passionate about. So Rishi Sunak's speech in the conference and trying to both appeal to his base of 2019 Conservative voters, but also really demonstrate a bit of a shift in the delivery momentum was not a massive surprise either.
And so is there any points, and actually, I mean, and we know, and we've heard it from Joe Mays and also Caroline Hepker, that, you know, a lot of the Tory party advisors are probably looking at the polls, they're in campaign mode, and are trying to get back that unbalance because Labour is doing so much better than them. But what are they looking at that could make people shift? Is it climate change? Is it even infrastructure, cost of living?
So the big things for them are having clear dividing lines between the policies of the Conservative Party and the policies of Labour. And this is something where it has not been as clear for the general population and the general public over the last 12 months. But with some of the clear dividing lines now being drawn around net zero, about HS2, some of those things are going to create a real shape around the policies for the Conservative Party. But the other thing for them is a lack of faith in government delivery. And when we look at how the public feel about how Rishi Sunak and his government are delivering on the 5 key pledges that they set out, there's a high majority of people who do not believe that they're doing a good job. So part of it is the dividing lines and being clear on the policies, but also being able to demonstrate that there is some delivery momentum. So even the change in the smoking, that piece, that piece, there will be a majority of the population. We've looked at some polls that have been done when that kind of policy came in New Zealand and polls done here by More in Common in the UK. There will be a good proportion of the population who think that is a really good policy. But I don't think that's going to be a dividing line. I think Labour will be more, equally in support of that.
But Kelly, is that, so for example, smoke, it's interesting because it's easy to deliver, right, as long as everybody votes for it. But if it gets put in place and it's something that's very actionable.
It is.
Are you going to see policies like that because your polls are saying that they just don't trust the Tory government?
I think there will be a range of short-term delivery mechanisms that government want to put in place. The big thing, I was at the conference earlier this week, the big thing that was a focus was we are going to fix inflation. That is what the Conservative Party were saying. And that is one of the core pledges that they have made to the British population. And there's a lot hanging on the delivery of that pledge in the Conservative member mindset. Once that moves, we can see if that does move and they manage to solve that problem, the public will shift their concerns, and we can see from the issues index that we have, which tracks spontaneous concern, that beneath the surface of inflation, when that goes away, it's NHS, it's public services, it's delivery around the immigration control that also the public are keen to see.
I mean, I find it very difficult because it's not only the government, right? It's a whole confluence of things that leads to inflation. So the idea that the government can have it is a little bit odd when you look at the economics of it. Talk to me about climate change.
Yes, indeed. So there have
people care, or are they trying to go for a certain part of the population where actually we think that we've gone too far?
So overall, the public in the UK, they do believe that climate change is a problem and we need to act. What the Conservative government have done with the shift in the net zero pledges and the timeframes, they are appealing to the 2019 Conservative vote, but they're also recognising what we have seen as a more nuanced view in public opinion about acting now. So whilst the public say to us, the majority would say, yes, we recognise this is a short-term decision, framing short-term concerns. Over half of the public are also saying they can't really think about climate change and the environment today because they're so worried about their own cost of living. So it is appealing to both the 2019 Conservative vote, but also those who are on lower incomes and more likely to feel the squeeze from some of the increases perhaps in their own lifestyle costs as a result of the policy shifts.
Kelly, Labour's doing really well. Is there a danger that, when we talk about this Ming vase that they just can't drop, but actually if there's not a bit of gusto or a little bit of policy behind it, that they're just going to slip in the polls?
So the gap, the voting intention poll that you show, that is a very crude indication of voting intention support. Looking beneath the surface of that, and we look at things like, do you believe Labour are fit to govern? Actually, there hasn't been a lot of movement in indicators like that. They tend to be about 30 to 40% of people, and has been for a long period of time, who believe they're fit to govern. What's happened? The proportion of people who think the Conservatives are fit to govern has dropped substantively. So you can see that it is more declinist view of overall context, negative views of the party brand for the Conservatives, and perception of failure to deliver rather than a love of Labour.
And so that, I guess, can change without the right policies in place, right?
That's right. And I think when we get to the time of a general election, people vote on leaders, they vote on parties, but they also vote on policies. And I think policies will be a big issue at the next election.
Kelly, thank you so much. Kelly Beaver, there, the chief executive of Ipsos, looking at some really, really interesting polls and analysis. Coming up, Rishi Sunak's U-turn on the government's green agenda. As we were just saying, under fire. We'll hear from one of his critics next. This is Bloomberg.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
UK billionaire and founder of Phones For You, John Caldwell, was one of the Conservative Party's most prominent donors. But he's now extremely critical of the Prime Minister Rishi Sunak's U-turn on green policies. Well, Caldwell has been lobbying the government for the past 3.5 years to try and create an environmental tech enterprise zone in the UK. He joins us now. So, John Caldwell, welcome to Bloomberg. First of all, Mr. Caldwell, why do you think the Prime Minister did that U-turn on some of the climate policies?
I think the UK population were a bit misinformed about what net zero means and what 2030 meant in terms of internal combustion engines. And instead of selling the positives and any negatives that there might be for people, explaining those negatives and explaining how the government would subsidise those negatives to turn the whole thing into a virtuous circle, I think he went for the easy votes. And it was a popular decision to reverse from 2030 to 2035, but it was completely the wrong decision. There's nothing more important for the world than the environment. And for Britain, there's nothing more important than growing our GDP. And we could have done both of those things at the same time.
Do you think, because of this decision, international investments or international investors will less likely invest in the UK?
Well, I think that's going to be a certain tendency, because what any investor wants is consistency. They want a government that sets the parameters in the economy and sticks to them and doesn't chop and change. And the chopping and changing is always detrimental to businesses. So yes, on that score, yes, but I wanted them to go a lot further than that. I wanted a real big investment in the UK from outside investors. And it wouldn't cost anything at all to create an enterprise zone that's tax-free for inward investment to come in, that are government approved in terms of their scientific technology on an environmental platform. And in that way, we could have grown our GDP enormously over the next 10 to 20 years, grown Britain and helped to save the planet at the same time.
John, do you think actually investment will leave the UK because of the government's green agenda or non-green agenda?
I don't think it'll leave the UK particularly, no, because I think it would require something more radical than that. But we're already a high tax regime. We're not investing enough in the future of Britain. And it doesn't look very smart for the future of Britain. And so it certainly won't be doing a lot to attract, other than the fact, and I would make this statement very strongly, that I think Great Britain is a very, very attractive country for people to come to live through from many perspectives. But we need to be better. We can't be complacent. We need to be better. And we've seen our economy in the doldrums pretty much for the whole of this century, for 20 years. So we really need to get our fingers out and be proactive in investing in future.
Yeah. Are you frustrated with the state of the Tories right now? You have been a big donor. Will you continue to do so?
Well, I am very frustrated, yes, because there's so many ideas that are put forward to government, so much that I believe we can do. And from my perspective as a businessman, just no-brainer ideas that you don't even have to think about. You just have to think about how do you how do you implement them, and how do you maximize the benefit from them. And so, yes, I am extremely frustrated. At the moment, I find myself in a bit of an apolitical space, because I believe in Great Britain. I believe in investing in Great Britain. I believe in making Great Britain really, truly successful in the future, narrowing the poor-rich divide, and doing all the things that gives the average working person a better standard of living. But it can only come from GDP growth. So you have to do that. So I'm not a supporter of anybody at the moment. I'm almost ashamed to say I'm a floating voter, because I've always been crystal clear about who I was going to vote for over the last 50 years.
But so, John, does it mean, and we've heard it from a lot of chief executives actually, that they have been wooed or at least impressed by Labour? Could Labour also impress you with some of the pro-business chatter that they've been talking about?
Yeah, I think the Labour's rhetoric is very good. It's very pro-business. It's very pro the environment, and ticks a lot of boxes. And Keir makes it clear that he wants to listen to business people and their ideas. But, you know, there's a big difference between electioneering and implementation. So whilst it does interest me, and I don't rule Labour out at all, at the same time, I am apolitical at the moment. I have my crystal clear views, and no party, any party properly represents my views.
But so if you're apolitical at the moment, would you rule out possibly being a Labour donor if they prove, you know, to be worthy for business?
I think, Francine, it's the same answer, you know, that I will support any party that I believe is investing in the right methodologies in Great Britain, not just throwing money at the voters, but investing in Great Britain, in our future, to make Britain great again, to give us a better GDP growth, so that helps everybody from the poorest members of society right through to the businesses.
Yeah. John, a real great pleasure to speak to you today. I hope you come back really soon, maybe in the studio next time. John Caldwell, entrepreneur and founder of Phones for You. Up next to Bloomberg Brief, we'll have a full roundup of some of the Treasury upheaval and, of course, a lot of the focus on equities. Danny Berger, Manus Crane. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Good morning from our world headquarters in New York. I'm Manus Crane.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Stocks and bonds remain on shaky ground ahead of tomorrow's U.S. jobs report. One-time bond king Bill Gross weighs in on the meltdown.
We're seeing a little bit of an oversold market here headed to 5%. A 5% 10-year Treasury is a decent value. It's not great value.
Oil's steepest drop in more than a year continues amid growing concerns over weakening demand. And Barclays dismisses 50 senior deal makers. We speak to a Wall Street veteran, Tom Naratil, who's making his mark in private equity. A very good morning to you all. Danny, we are held hostage to the daily terrorism of data, whether it's on the oil market or the bond market. I can tell you this, as far as the bond markets are concerned, we had this parabolic move higher, and it is continued. Bill Gross there, you heard him say, it's not great value at these levels, and it's interesting when he talks about who are the bond vigilantes. They're no longer the institutions, the bonfire, the vanity institutions here on Wall Street, but it is you and me, individuals who are taking the pain and capitulating. That is the interesting point. By the way, it's going to take a heck of a lot more of a dump in the stock market before anything comes to the rescue of the bond market. More on that Barclays note in a moment. Oil is down, again continuing. The data is turgid. Gasoline demand, the weakest in 25 years. That is what irked this market. We are in demand destruction. JP Morgan have made it really, really clear. Demand destruction is here, and still Saudi and Russia go ahead with their cuts. Dollar yen, I thought we'd just put it in there. Every day we're checking whether did they intervene, didn't they intervene. Well, we have the data, a little bit of data now to suggest perhaps the Bank of Japan did not intervene. I want to leave you with a snapshot. Look at that two-day move in the oil market, down 6% yesterday, and here we are, we continue lower again. What does that mean for central banks? What does that mean for global demand? What does that mean for recession watch? Danny Berger, good morning.
Good morning, Manus. It's the downward momentum that's concerning, right? We did have this turnaround in bonds and equities yesterday after the ADP report, as you pointed out. But it is concerning that we're unable to hold on to that. It doesn't bode well for whether this was actually a turning point. Your S&P futures down 0.4%. Just as an example, here's what the market did yesterday. NASDAQ ended the day up nearly 1.5%. Somehow, amid all of that, Europe is able to eke out some slight gains, but just slight, up about 0.1%. Emmanuel Coe says that at the moment, cash is the only thing that is attractive, that stocks are going to fall further with yields moving higher. But Manus, we've talked a lot about how historic this bond rout has been. Let me put it into a picture for you to show our viewers just how bad it is. For our radio listening audience, I have a Bloomberg index that is basically long-dated bonds from the peak to trough of how bad the drawdowns have been. We'll get to that chart in just a moment. Manus, the drawdown basically is half from the peak of March. We've drawn down about 46%. There it is. That rivals the bad meltdown we saw in equities in the dot-com bubble burst. That's just how bad this drawdown has been.
But Danny Berger, you know, when you buy bonds, you buy them to maturity. YTM, yield to maturity. So that bloodbath, I mean, I'm trying to give myself a reason to sort of look at that chart and go, is there any reason why you would continue to hold it? Just, are we at a capitulation point of where there is divestment? Barclays have a cracking big note out this morning. They say, look, there's no magic level in these bond markets. You know, and the 5% drop that you've had in the equity market, as I just showed you, is not going to be enough to save the bond. In other words, you're not going to turn around and say, I'll buy bonds because equities are down by 5%. It's going to take something an awful lot more, Danny.
Yeah, it's this weird chicken or the egg thing, I must say, because there are people out there who say yields need to go higher for stocks to sell off, but then apparently stocks need to sell off for yields to stop going higher. It is melting my mind. All I can say, Manus, is this doesn't look good. That's the only one thing I can say for sure.
Well, we don't want your mind melting, but our next guest says there's nothing worse than being higher for longer in this paradigm world. It's Orwellian doublespeak for where good news is bad news, strong is weak, and high yields hurt equity multiples now and corporate profits in the future. What's she doing about it? Is her head melting? Maria Weidman is Senior Multi-Asset Strategist at State Street. Are you so chastened that you want to run to a mountain of cash? Maria, good morning.
Yeah, good morning, Manus and Danny. Yeah, I think, I mean, it's very difficult. I mean, I'm mostly a very positive and optimistic person, but it's really difficult to find something to get excited in financial markets other than cash right now. So to us is that the U.S. economy is still strong enough, and that is going to keep Fed on its toes, and that's higher for longer, and we see what it does for bonds, we see what it does for stocks. So cash seems to be really the only reasonable alternative.
What do you make of this Barclays argument, Maria, that once stocks sell off, then bonds can stop their sell-off?
Well, I think it's about economy. It's not about financial markets. And I think central banks, and Chairman Powell showed it to us many, many times. He cares a lot more about inflation, about real economy, about labor market than stock market. So I think the question is at what point labor market slows. It's not at what point like stocks crack.
Yeah, but then you look at the JOLTS data, and that ripped the bond market apart. And then you look at the ADP data yesterday, the least amount of private jobs since 2021. And suddenly everyone, oh, great, you know what, we have a relief. So it's ultimately the jobs market that's going to stop the rot in this bond market, Maria, but it doesn't look as if the US is about to crack anytime soon.
Yeah, no, I agree with that. I suspect, we know that JOLTS numbers are volatile. We know that ADP numbers are volatile. So one was too strong, other was too weak. So truth is probably somewhere in the middle. I would probably trust JOLTS a bit more than ADP, but we have payrolls on Friday, so to add more confusion to this discussion. But if we look at GDP revisions, if we look at economic surprises, if we look at consumer sentiment, so there is still enough strength. So consumer is still spending. So until that stops, I think we're in higher for longer. So I think it's a little bit early to look
why can't I say, okay, the consumer is spending more, the economy is doing strong, sure, higher for longer, but that sounds like earnings will be fine. Why can't stocks be okay in that environment?
I think higher for longer means that recession will happen. It won't happen this quarter. It's probably not going to happen next quarter, but it will happen. Why consumer has been so strong? They had savings and they had a very, very low interest rates cooked in before COVID, before rates started to go higher. All that is running out. It can't be there forever if Fed has increased its interest rates that much. So we haven't seen recession, but it doesn't mean that monetary policy doesn't work. We just wait a bit more, and we will already see cracks happening. So we'll see more and more of that.
Well, Maria, the crack certainly came to pass in the oil market yesterday. I haven't seen many 5.5, nearly 6% moves in the oil market. Down she went by 6% yesterday. And yet, if you look at this, you say oil will stay high. Saudi Arabia and Russia are continuing with their cuts. But what I love to know when you find somewhere that's not too crowded, why do you think the energy trade is not too crowded? Is it the commodity side of the trade or the equity side of the trade?
Equity side for sure. So, at State Street, we are privileged to see what institutional investors within our custodial database are holding. And the holding overall in energy stocks have increased from fairly low level. Investors bought energy stocks, but they haven't bought enough. So there are still opportunities there. We also see energy stocks lagging energy oil prices, so there is some catch-up there. And energy stocks generally look really attractive. They're probably one of few stocks that can generate a lot of cash now. They can afford fairly hefty dividends. So in a world, like in my world, where I'm really worried about recession and I want to run away from stocks, maybe there are relative opportunities in energy relative to, say, industrial or materials. So to me, that trade looks attractive.
See, Maria, you said you didn't think there's anything you could be optimistic about. You found it. So we're all happy about that.
Just ask me about tech.
Oh, you want to get into tech, Maria? We got a minute left. Take it away. What's your thought on the Magnificent Seven right now?
Oh, love them. I think if we're going into recession, we do need to find somewhere where you have quality earnings, and earnings can be defended, can be stable, have stronger cash flow, and that's definitely not banks, that's not industrial, so you might have some sprinkling of healthcare. But tech sector is something that is proving itself to be somewhat resilient, and high valuation doesn't worry me, long enough.
Maria, thank you very much for that. That is Maria Weitman of State Street. See, giving us two things to be positive to wrap it up with.
Reasons to be cheerful.
All right, Manis. We need it. All right, Manis, now to some of our top stories. Take it away.
Okay, we got the Florida Republican. Matt Gaetz says he backs speakership bids by both Representatives Steve Scalise and Jim Jordan. He spoke to Bloomberg yesterday.
I'm for both of them right now. I'm eager to hear their plans and their vision. But if the House of Representatives goes from the stewardship of Kevin McCarthy to either the stewardship of Jim Jordan or Steve Scalise, that's going to come to the delight of many conservatives.
Elsewhere, Caroline Ellison, the former CEO of Alameda Research and Sam Bankman-Fried's former girlfriend, has quickly become the focal point of the FTX, if I can find my word, founders fraud trial in New York. Bloomberg's Sonali Basak filed this report.
Over the 6-week trial, dozens of high-profile testimonies will include Caroline Ellison, Bankman-Fried's former girlfriend, and investor Anthony Scaramucci, whose firm had taken money from Bankman-Fried's firm. They are expected to testify with dozens of others, and the defense still says working at a startup is like building a plane as you're flying it, and that no one CEO or person can be everywhere while managing such a fast-rising firm. Remember, FTX had almost 6 million customers at its peak. Bankman-Fried may spend most of his life in prison if found guilty. I'm Sonali Basak in New York for Bloomberg Television.
And Barclays is dismissing about 50 senior deal makers. The layoff is said to be part of a plan to trim headcount by about 300 people across the corporate and investment banking divisions. That amounts to 3% of the total headcount at the unit, which includes Barclays trading operations. And later this hour, we speak to Tom Naratil, former top executive at UBS, who's now making his mark in the private equity world. Up next, another hurdle for Congress. U.S. aid for Ukraine hangs in the balance as the scramble for a new House Speaker continues right here on Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Krani in New York. Matt Gaetz, the Florida Republican who led the push to oust Kevin McCarthy as House Speaker, discussed government spending with Bloomberg's Anne-Marie Hordern and Joe Matthew on Balance of Power.
I think that the downgrade from Fitch was largely driven by the fact that there's no real backstop to spending. So here's what we need, no matter who's the speaker. We need a top-line budget that, at least in the House of Representatives, returns to pre-COVID spending levels, and then we need to be able to have single-subject spending bills with open amendments to have programmatic review of agency spending.
Well, Congressman, let's talk a little bit about what just happened. Nobody's ever done this before. It was history-making yesterday, the ouster of the Speaker. We're told that you are the least popular man in the House of Representatives, or at least in the Republican conference. In fact, just yesterday, your Republican colleague from New York, Mike Lawler, suggested violence against you in an interview right around this time yesterday. I'd love for you to hear what he said and have you respond. Here's Mr. Lawler.
The only thing that I would have done differently is flung it
in the direction of one person. Look, he absolutely epitomized the frustrations of the conference and the American people.
Was that person from Florida you're suggesting?
Oh, yeah, I would have hit him square between the eyes.
He was going to hit you square between the eyes with the speaker's gavel, he was suggesting, Congressman. Do you expect to be expelled from the Republican conference?
Oh, I don't know. I think that was a very frustrated person who's having to come to grips with the stages of grief. My mission is to ensure that the House of Representatives runs better, because the way we've been running Washington, D.C. for the last 30 years has led us to a point where no one is really responsible for the spending. We are backed up against shutdown politics. We are governed by crisis. And the biggest problem is lawmakers have to take one up or down vote on continuing resolutions and omnibus bills to either fund or not fund the entire government. That truncates the type of thoughtful and serious analysis that we have to apply to how the federal dollar is being spent at a time like this.
Representative Matt Gaetz there on Bloomberg's balance of power. President Biden is planning a major speech on the need to give additional aid to Ukraine. He spoke about his plans last night.
We can support Ukraine in the next tranche that we need, and there is another means by which we may be able to find funding for that, but I'm not going to get into that now.
Now, support for Ukraine is top of the agenda also as European leaders meet in Grenada today. Joining us now from there is Bloomberg's European correspondent, Maria Tadeo. Maria, is there a lot of cohesion when it comes to Europeans' plans for long-term assistance in Ukraine?
Look, we're about to find out. And in fact, President Zelensky has just arrived to this conference that is taking place in Spain today. And it was not a given, we should note, that he would attend the summit. In fact, at the start of the week, we were told that he would not attend, and instead the Ukrainian prime minister would take his place. Instead, he had a change of heart yesterday and decided to be here. And you can tell the incentive for the Ukrainian government, because this has been a difficult week for Ukrainian diplomacy. On the one hand, of course, we had the shutdown deal, which left some of the aid for Ukraine outside of the package. Then maybe this seems trivial, but there was a post by Elon Musk which showed a man that was sweating, asking for cash. That was supposed to be President Zelensky. That infuriated Ukrainians, and in fact has circulated in terms of the zeitgeist of maybe public opinion turning away from this idea of stand with Ukraine for as long as it takes. So today, the Ukrainian president, of course, is going to have a number of bilateral meetings with European leaders. But beyond that, there's also the optics of this meeting. He wants a picture, a photograph that shows he is engaging with international leaders, that he's not alone, and Ukraine is not alone in this war.
Maria, good to see you this morning. How concerned are the European leaders about this waning U.S. support?
Look, man, the one thing to know about European leaders, especially when we talk about the European Union, is that for them, until now, the Biden doctrine had been very, very easy to read. They knew that meant weapons for Ukraine. They knew that meant support for the country, and also meant money, funding for this country. Obviously, that could change in an election year, and we see it play out with some of the political instability, perhaps, that we've seen already play out in the United States. So this was a concern already going into the election. It was talked about privately. This is not new. European leaders were obviously positioned potentially for this election, and maybe even a change in government in the U.S. But I think this week, what they have seen is this is a controversial issue. It's playing out very publicly in the United States and has accelerated some of those fears. It also brings up a big question as to what happens if the United States pulls back from the Biden doctrine. What I should say, however, this morning, there is a lot of curiosity in terms of that speech that the president said he would make. Remember, he said a major speech about the need for long-term funding for Ukraine. He said that even if Congress does not approve, there's still ways to get money for Ukraine. That's something that's gathered a lot of attention here.
Well, it's only going to be interesting to see what happens in the next 40 days and where we land on this. Maria, thank you very much. Maria Tadeo in Granada in Spain. And a quick check on these markets. 24 hours ago, there was a moment of reprieve in these bond markets in terms of rolling off their highs. You can see yields rising ever so slightly this morning, 475 on 10-year government bond yields. They're not great value, according to Bill Gross, just yet. This is Bloomberg.
is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Brief. I'm Menace Granny in New York, Danny Berger at London HQ. So Walmart says it's already seen an impact on shopping demand from people taking the diabetes drug Ozempic and other appetite-suppressing medications. The retailer is studying changes in the sales patterns using the anonymized data. There's a word for you, anonymous data, from their shopping populations. Danny.
I just want to know how we're talking about Ozempic for a second day in a row. Got to stop the madness.
Well, I just don't want to say. All I said to you yesterday was it's half the price in Dubai than it was here. Danny, good morning.
Good morning, Manus. We'll leave it at that. All right, let's talk about football because the World Cup, it's coming to North Africa for the first time. Morocco is set to co-host the 2030 tournament along with Portugal and Spain. But the event will also see a game played in 3 South American countries. Here to explain is our resident football expert. It is Bloomberg's Greg Tanner. Greg, so explain this to me. If I'm a fan and I want to go see a match in Uruguay and then just shimmy on over to Morocco, or even a player for this matter, I mean, how is that going to work?
Long flights, time zones, jet lag, probably. It is complicated. I think the tournament proper being split over 3 countries is unusual, but it's not unprecedented. In 2002, we had the World Cup split over South Korea and Japan. The one coming up in North America in 2026 is going to be the US, Canada, and Mexico. So the fact that they split it over 3 countries isn't that surprising. What is surprising are these 3 games at the beginning of the tournament in Uruguay, Argentina, and Paraguay. And they're basically, what people are believing, throwing them a bone that they didn't get the tournament proper. It's the centenary. It's 100 years since the first World Cup was held in Uruguay, and they won it. So the feeling is they've given this consolation prize. You can have 3 games, but then the tournament proper will happen in the other countries in North Africa and Europe.
Well, our consolation prize is that you're in London and not in the Middle East, and then you said yes, you'd stay late. You'd stay late at school and be with us. So come on then, what's going on with Saudi Arabia? I mean, they can't be left out of anything to do with sports. Quick line, we've got 30 seconds. What's the top line for Saudi?
Well, there had been thoughts that they might have gone for the tournament that just got awarded with Greece and another country. They didn't do that, but they have confirmed they are going to apply for 2034, and it's only going to be somebody out of Asia or Oceania who is in the running. So they got a good shot.
Well, you know what, Greg? I've got a bit of form in covering football in Qatar with the odd header here and there. So if you're looking for a correspondent, I'm on the block. Greg Tanner, transplanted to London from Dubai. Next up, Tom Naratil.
faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3,000,000% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He
story.
is there, the kind of upside.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Stocks and bonds remain on shaky ground ahead of tomorrow's U.S. jobs report. One-time bond king Bill Gross tells Bloomberg treasuries are just a little oversold. Oil claws back some gains and then falls again after falling the most in a year amid growing concern over weakening demand. And Barclays dismisses about 50 senior deal makers. We speak to a senior deal maker ourselves, a Wall Street veteran, Tom Naratil, who's making his mark in private equity. Meanwhile, here in public equity land, we're unable to sustain the gains of more than 1%, at least for tech stocks yesterday. It is a bad sign that the turnaround is not taking hold. We're back down again, down about 0.4% for both S&P and NASDAQ futures. European stocks are holding on to something. I'm not too sure what at this point, but we are a little changed. And of course, Manus, Barclays warning that stocks need to look a lot worse. A 5% drop isn't enough to steady the bond market at this point.
No, not at all. And it doesn't even look like tantalizing value for Bill Gross either in the bond world. Maria Vaidman from State Street just with you and I saying she'd prefer to be in cash at the moment. Let's check in on these yields. You saw parabolic rises set off by the JOLTS number on Tuesday, a reprieve yesterday on ADP, adding the least number of jobs since 2021 in the US. But still, these yields are incrementally pushing higher. Bill Gross says the market looks a little bit oversold. The vigilantes of old, in other words, those Wall Street institutions and asset managers, perhaps are being challenged by who the vigilantes are of today. They are individuals like you and I who are long ETFs, who are hurting brutally. And if you look at the collapse in the bond market by over 50% from its highs just a couple of years ago, oil continues lower. This is a cascade lower in the oil market. You saw it drop by nearly 6% yesterday. We are in the world of demand destruction. That's according to JP Morgan. There you go. Again, we continue lower. Demand destruction is live. Why? Gas demand here in the United States of America is the weakest in 25 years. So is that an anomaly or is it something that will continue? Dollar yen, you see the dollar slightly on the back foot today, ever so slightly. And with that in mind, it transfers into dollar yen. We've got a little bit of data through on the current account, on the current account data from Japan, and that says very clearly that for now, we don't think that there was intervention in the yen. Danny?
Yeah, look, it's an interesting one, and also interesting. You pointed this out to me that we also heard from Richard Clarida. He was, of course, speaking. He had a note out saying that at some point Japan will have to abandon YCC, and that point will come soon. Again, it goes back to this Kit Jukes thing of earlier when we spoke to him, Manus, saying you cannot have your cake and eat it too. You cannot try to keep the bond market in this band and at the same time have a currency that doesn't appreciate. So Bank of Japan still forever in focus for us.
Absolutely. And then you got Marco Papic a little bit earlier in the week talking about the possibility that an uncontrolled bond market in the United States of America could invoke YCC. Anyway, let's shift the conversation along. YCC is a long way down the road, some would say, here in the USA. One man that's seen a season or two in the bond markets, in volatility, in raising capital and doing deals is Tom Narisville, previously holding several senior positions over the past 4 decades at UBS, including co-president of UBS Global Wealth Management and president of UBS Americas. He's now an operating partner at the private equity firm Lightyear Capital, where investments are in wealth management and financial services sector. Good morning, Tom. Good to see you.
Good morning, Manus. Great to see you.
You've gone to the dark side, private equity. I hope they've welcomed you. The fund, talk to us a little bit about the fund. I think there's about $4 billion in it at the end of last year. So set out your stall. Where are you going to take that fund to? How big can you grow it? And are you actively raising money at the moment?
So let's talk a little bit about what I'm doing, what I'm focusing as an operating partner, because I'm part of a larger team at Lightyear. My focus is on the asset and wealth management space, not surprisingly, given my background. And that's a great place where Lightyear's had tremendous record in terms of helping companies to raise growth capital and to help them succeed and grow in the future. So that's what I'm going to be focused on.
And with that in mind, I mean, I look around the wealth management space, and there's this debate, isn't it, with Jamie Dimon talking about AI, doing the hedging for them, being involved. For us, with this fund at Lightyear, is it AI deals that you think you're going to look at more in the wealth management space, or is it human capital? Is it still, Manus, I still believe that wealth management needs a large element of human capital. Where does the balance come?
I would say it's tech-enabled wealth management. AI is going to be extremely important to the wealth management industry, but the best parallel is if you think about software developers and GitHub, they have Copilot, which actually assists software developers in becoming more productive, learning what different coders are trying to do, what their style is, and giving them prompts along the way as they're working on code. I've seen demos of fintech that is setting up to help client advisors to be able to do the exact same things as they're engaging in conversations with their advisors, with their clients.
Hey, Tom, Danny here in London. Really great to speak with you. Even beyond just the technology revolution, in today's plain basic vanilla markets, it's tough. 60-40 is getting pummeled. A day like yesterday where commodities sold off, risk parity is struggling, and then you have all these cheap ETFs you can go out and buy are really accessible. So where do you think asset management and the companies that you're looking at fit in that world?
Yeah, so Danny, you definitely described the problem out there quite well. I think what you're describing tells you exactly why the wealth management industry is in a bull market for advice. There's so much going on out there. If you think about just the amount of content that you cover in your show in just an hour, there's a lot for a client to have to sort through. And that's where a client advisor, financial advisor fits in the wealth management space. Right now, as you asked about the old 60-40 model, that is, I would say, the old model. The new model and what advisors should be doing with their clients right now is talking to them about diversification, rebalancing, and a lot of that rebalancing is out of the public markets and into private markets.
And with that in mind, is that what you're seeing a lot more interest in, as it were, from clients on the wealth side? You're a veteran of this, so the opportunities are for the clients more in private markets, private credit. We've done a lot on private credit here in the past couple of weeks, and private equity. Is that where the big opportunities are?
Yeah, if you look at allocations right now, Manus, across the industry, you're probably around 4 to 7%, and most of the CIO type teams are recommending 15 to 25% for ultra high net worth clients. So there's a significant shift to occur. It's not a shift that's going to occur immediately because clients need vintage diversification, in addition to style and manager diversification. So this is if you think about wealth management being the long-term bull trend in terms of an advice market, then there's a double bull on the side of the alternative managers in terms of servicing wealth management clients.
Tom, someone once told me, a private equity manager, that every manager in their back pocket has a plan to go public at some point, but it's been a challenging market for IPOs. Manus and I spoke to Philip Freise, co-head of European private equity at KKR yesterday, and he told us that the route of IPOs moving forward is going to continue. Tom, just take a listen to that.
Unfortunately, the next boom is not just around the corner. This is going to stay tougher much longer. Great companies will have space to go public, but you will not see what we saw before, a large series of IPOs with companies of average quality. We have not seen, and I've done this for 22 years now, as much interest in public company CEOs, in entrepreneurs and families to take their companies private today than we've ever seen.
So, Tom, we used to be in an environment where asset managers, advisors, they would go public. Is that over? Do you see that sort of exit route for the type of companies that you're taking?
No, Danny, it's not over, but in the current environment, it's not the preferred route because it's not the best way to secure capital and the valuations that you want to see. So I think the private equity market is certainly quite robust in terms of being able to evolve to different situations. I'd say today, a lot of times you can see better valuations on exits in the private space versus the public space, and until that shifts, that'll be the direction of travel.
I want to get a sense of where you want to sort of beef up the array of companies that you've got money in. Danny and I were just looking at some of the deals we've done. JP Morgan bought out Nutmeg, obviously. Then you've got Goldman's doing deals in Chicago, etc. In your space, the natural question is it going to be all US deals that you're going to try and look at? Are you actively looking in Europe and the UK? Is it culturally a better fit here, tech wealth, than it is there?
So I would say if you're thinking about tech enablement, tech enablement's going to work globally. And our portfolio, although being primarily focused on the US, does have some international exposure, including in the UK.
Hey, Tom, you know, there's some stuff for sale here in the UK, specifically OD Asset Management. There's been lots of reports that they're looking at selling parts there, given the drama. Would you ever buy anything from them? Have you gotten a phone call from them?
I wouldn't comment on anything specific in terms of names.
Deftly sidestepped. No calls, no comment. Well, we'll come back to that in a wee moment. We'll give Tom a little bit of a break. He's braved 6-7 minutes so far, Tom Naratil. Lightyear Capital stays with the brief team. We discuss the macro environment. We get his outlook. We might even sneak a question in on UBS. This is Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The dots at the September meeting had 12 of the 19 participants indicating one more hike. I'm less of that view now. I think given that, as I said, the bond market can do some of the Fed's job for it, you know, if even some of this recent increase were to stick, I think the Fed could well be done.
Former Fed Vice Chair Richard Clarida there discussing his reasoning on why we might have reached the end of the Fed's rate hiking cycle. We're back with Tom Naratil, a former top executive at UBS, who's now an operating partner at private equity firm Lightyear Capital. You've seen a cycle or two, right?
One or two.
One or two. This bond market is giving a serious swag. Jamie Dimon flies the kite that rates could go to 7%. You read a lot now. You're outside the day-to-day machinations of rates. But when you see the market so convulsed this week, can you see a scenario where we're really underpricing what more the Fed has to do?
I think it's a little bit less about what the Fed has to do. I think after being behind the curve, you know, they've caught up. They've made it very clear that 2% is the target. I think it's very important to listen to what Jay Powell is saying when he says higher for longer. I think he does mean higher for longer. But I do think some of the consequences that you're seeing in the longer end of the curve is, you know, what are some of the supply-demand fundamentals in the U.S. Treasury market overall? What's the compounding impact of higher rates on the federal deficit? And is there really going to be enough compromise in Washington to get the deficit under control? So I think some of those things are starting to feed through.
What could shift the bond markets convulsing this week? Because you ended with Washington and deficits. Could that be the trigger that causes rates to top out? Some kind of a fiscal...
Yeah, it could, but I don't think that's likely in the cards in terms of the current climate in Washington that we'd see a solution to that. So I think we need to see higher rates forcing the hand of policymakers in Washington to do what they need to do. So this is, I do think, you might say this is going back to my early roots, but it is the return to the bond vigilantes.
Tom, is there a world in which higher rates also force the hand of the Fed? We saw it in the gilt market. I realize they're very different markets with very different players in liquidity, but is there a risk that with these parabolic moves we've seen that it gets out of control and the Fed needs to step in?
Well, I think maybe it's, Danny, if that were to occur, maybe it's a bit of a step back. You know, we did, after a massive amount of QE, we're now in the process of QT, and we might be seeing some of the consequences of that. So the Fed has the ability to moderate that if they wish, but I'm not so sure if you think back historically on where we've been in rates that we're really out of whack considering where we are in the economy.
You see, there's the whole point. You've seen multiple cycles and multiple rate hikes. You've seen 15% with me in sterling, you know, when the Bank of England had to save themselves. So if we're just getting back to normal, Tom, in terms of rates, term premium is returning, real rates are trending higher. Do they continue? Do we continue? Are we at normal, or is there much further to go, do you think?
I think there's a bit more to do on the upside in yields. I don't think it's the 7% number. That's possible, but I do think another 50 basis points or so is something that the market could absorb well, and it would probably reflect where we are in the economy. I think if you look at what's happening with labor here in the United States, the labor market's pretty firm. At the same time, if you look at strikes that are going on, if you look at some of the pay increases that unions have been able to negotiate for their workers, the worker who's not in a union is going to start to ask some questions to their employer about what their pay raise is going to be, and I do think that's going to keep some pressure on inflation, make this last move down towards 2%. The last 180 basis points or so is going to be a heck of a lot tougher than what we saw previously.
Just to put it plainly, do we need a recession to get there? Is that what the next move is?
Danny, I don't think it's a traditional recession in the way that we've known it. I do think we may see a rolling recession, or we may in fact be seeing a rolling recession right now. That'll keep the GDP figures still in positive territory, slightly positive, but we will see labor adjustments in certain sectors. We will see declines in production in certain sectors, but overall, the consumer in the U.S. still appears to have a pretty good heartbeat.
One thing we are tracking is the short interest on some of the banks. We saw the SVB, the First Republic crisis. The market is now shorting banks like Billio. Do you think we could have another, are we building up under the hood some other banking issue with this kind of shorting going on and the flow of money into market funds? Is the ruction done?
Maybe I would talk about that a little bit differently, Manus. I'm not so sure that where we are at this point is the place to add to that short currently. But I do think there are a lot of headwinds that you're seeing. We'll certainly see how that's reflected in third quarter earnings seasons for the major banks. Mm-hmm. But I would say regulators certainly noticed what happened in terms of the banking crises that we saw earlier in the year. And as a result of that, capital requirements are going up. Capital requirements going up, liquidity requirements going up, ROE under pressure. That certainly leads to someone wanting to take maybe a less long position in banks.
I bet you're relieved that you don't actually have to sit around the board anymore at UBS and sort of talk about capital requirements and liquidity. But we'll give this a go. I mean, it's been an amazing year in Swiss banking. Sergio Motti is back. The two beasts of banking are born. It was a marriage of great inconvenience. What is the biggest structural problem in this integration? What's the biggest challenge in this integration for Motti and the team?
So first, I think if you look at what Sergio and the team have laid out in the past earnings announcement, it's actually quite clear. Now it's just all about execution. So what are the areas of focus in the execution? First is run down the non-core assets, which have been identified and ring-fenced. The second component of that is the integration of the components of the bank that are going to be merged together. You see that in the Universal Bank in Switzerland. You see that in wealth management. You see that in the investment bank. You see that in asset management across the board. And then have your shareholders comfortable with the fact that your core businesses are still operating quite well. So I think if you think about the challenges that face UBS, this is like a perfect Hollywood casting moment. And Sergio Ermotti is the right CEO for the challenge at UBS today. If you look, you've got a very solid and strong chairman in Colm Kelleher, and you've got a very experienced executive board team.
Well, Tom, they tried to cast you in this Hollywood narrative. We've got the reports that Sergio called you up to get you to join. What was that phone call like? How'd you turn down the silver fox himself?
Well, the only thing I could say is I'm not so sure I'd always believe everything I read in the press.
Well, Tom, I think you would have fitted in great with this. The Hollywood door revolves, Tom. You can always make a comeback. Sergio certainly did. It's been great to see you. We wish you well with Lightyear. Come back and talk to Danny and I with your first exit. Make sure that we get the exclusive on that, on when you do a deal. We wish you well. Thank you for giving us your time this morning. We appreciate people getting up early in New York. Tom Naratil, Lightyear Capital, on The Brief this morning on Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg Brief. I'm Danny Berger in London. Manish Cranny is in New York. And let's get you set up for your trading day and a look at what is ahead. It's going to be a big day for Fed Speak. We're going to be hearing from Loretta Mester, Tom Barkin, and Michael Barr. Also, tune in for our interview with San Francisco Fed President Mary Daly. That's at 12 p.m. Eastern. Plus, we're going to get another round of jobless claims in the U.S. That's at 8:30 a.m. Eastern. Can the jobs data yet again cause ruptures in this bond market? And EU leaders are meeting in Grenada today and tomorrow as support for Ukraine has come under increasing threat. But, Manis, again, as I said, we've seen time and again over the past few months that it is the data that sets off different directions and a lot of losses in this bond market.
Look, we had this eruption parabolic moves on the back of the JOLTS number coming in stronger and more muscular, I think, than the market had anticipated. Then ADP gave us that, bad news is good news. We just had a conversation with Tom Naratil saying he thinks the market can take another 50, 60 basis points in terms of the upside in yield. And I think that was an interesting take. He talks about fiscal largesse, and he talks about the bond market putting pressure on Washington.
Yeah, and I also think the point he made was really important, that what the bond market is doing, you can see 10-year yields are not to move today, but it makes sense based on what's happening on this economy, that there is more inflation, that there needs to be higher and longer. For all of those really worried about the ruptures in the bond market, Manis, perhaps it makes perfect sense because we need to price out some of the cuts that were priced in for 2024.
Absolutely, and I love the Barclays note, which says, look, there's no magic level in this bond market that would make it a buy. You're going to have to see stocks tank furiously before you take on a little bit of bond risk. And that oil market is definitely demand destruction wrote large. Danny.
All right, that's it for Bloomberg Brief. Surveillance is ahead on Bloomberg.
been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We see this steepening, and I think that should give investors pause and think that really there is a fiscal risk premium coming back into the Treasury market.
One of the reasons treasuries are so high compared to other parts of the bond market is simply there's such an enormous supply of treasuries.
For all intents and purposes, there's a buyer strike in the Treasury market.
Obviously, we're focused on that 10-year. Right? The 10-year needs to stabilize. Everyone's watching that.
The fact that 10-year yields are higher, I think, is probably consistent with what the Fed is trying to achieve.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Some calm after a bond market storm. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market slightly softer, down 1/3% on the S&P. Best day of gain since mid-September on the S&P 500. Bonds, Tom, just settling down just a little bit, going into payrolls.
I'll go with that, but it's very fragile. We'll get into the data check right now. I'd say it's a calm, yes, but a fragile calm at best. After the festivities in Washington, the Matt Gaetz interview that Anne-Marie and Joe had yesterday, after the bond pieces are picked up. John, I've had time to look at a set of charts. I'm not going to bury you with them now or the details, but it's a Peter Pan economy. It is never, ever. I've never, ever seen some of these charts in any of my studies. They're not in Fibonacci. That we're in a bond land that's, Bob Michael or Steve Major would say it's never, ever.
So the Bloomberg team has done some fantastic work on the numbers. The price destruction we've seen on the long bond.
Exactly.
So bonds maturing in 10 years or more, some great numbers here, have slumped 46% since peaking in March 2020, according to data here at Bloomberg. Just shy of the 49% plunge in US stocks in the aftermath of the dot-com bust. So Tom, you've been on top of this over the last couple of years. When the sell-off really got going, the destruction we've seen in bonds, almost as bad, by some measures worse, than what we saw in equities in the dot-com bust.
The timeline, and there's, again, there are a whole bunch of charts, a whole bunch of nations we can go to. Let's look at John Farrow and the 30-year gilt Farrow's loaded the boat on. That's worked out. The price takes you back, John, on a 30-year British bond, 1998. We're going back to 06 here. 05, 07, maybe 00. You're going all the way back to the great financial crisis. On radio, this is a very tough chart to see on the x-axis, but the answer is we are back to that financial crisis of 1998.
Do we need bad news to put a lid on this? Maybe, Bramo, we do. And maybe it's a ADP report that nobody cares about that sparks the big moves that we saw yesterday. Amazing to see, right?
It was amazing to see. The fact that Barclays came out and said that the one way to get a rally in the bond market is to see a crash in risk assets. This is essentially what it seems like is the prevailing thought, that essentially if things get bad enough in financial markets, it will get the Fed to reverse course on some level. It'll get a bid into bonds that just isn't there. And at at a certain point, my real takeaway from this is there is a deep frustration at the resilience of stocks to some of the sell-off.
Yeah,
because
there's
that would
a
be
hope.
the circuit breaker.
A lot of people are circling the word hope, saying, geez, I hope stocks go down. There's a lot of that going on this morning. But, to get out front of October 13th and on, I get it. Most banks will survive. They'll have VAR, they'll have risk, they'll have Red Nassim Taleb. I get it. Come on, there's got to be a couple people getting hammered right now.
Well, there are at the moment on the bank stocks, right? The Charter Bank of America.
But I mean on their balance sheets, I
City.
mean internally. I mean, you've got this wonderful conversation today with Mary Daly at the Economic Club of New York. I mean, not Mary Daly or any other Fed president or governor, but their staff. You don't think they're looking this morning at selected 200 banks?
My guess is that every morning they look, they try to understand. Is it going to be a circuit breaker moment, though? Or is it going to be a slow grind that's a kind of boiling the frog moment where basically credit gets withdrawn from the economy and then suddenly there's a wake-up moment where suddenly people realize this is a very different economic trajectory with a much worse outlook?
Don't use boiling the frogs with Mary Daly, because they have restaurants in San Francisco where you eat frogs.
Make frogs?
Yeah, you eat frogs.
Which restaurant would that be?
I don't know. I've been at them. I've looked at the menu and said, are you kidding me?
Can I call you out? Actually, you started out by John saying it looks a little better. You said, just wait. What is this, gloomy Tom?
It's the both of you, apparently. It's 2 against 1.
If you line up an N,
an
okay,
optimist.
take a statistical N, okay, take 30 banks in whatever category. Guess what? 29 of them will be fine. And there's just going to be somebody who got the trade wrong, got the overnight wrong. We'll learn about it. But
There's
I'm
some
sorry
big
to say,
unrealized
leverage.
losses out there. I'm with you. JP Morgan earnings kicking off in 2 Fridays' time. Next Friday, October 13th. Let's check out the price action. Equity futures on the S&P 500 declining just a touch, down 1/3%. The best day on the S&P going back to mid-September, all the way back to August for the NASDAQ. Decent day of gains off the back of a big move in the bond market. Yields lower. Yields stable this morning, going nowhere. 473.73 on a 10-year. And the euro against the dollar, pretty much unchanged here, Lisa. 105.06.
So is bad news good news again? 8:30 a.m. we get U.S. initial jobless claims. Curious to see whether we actually see it tick up after basically a moribund chart since the pandemic. You've seen it just flatline. This is one key aspect people are looking at. The Fed speak today includes Cleveland Fed President Loretta Mester at 9 a.m., Richmond Fed President Tom Barkin at 11:30 a.m., San Francisco Fed President Mary Daly at noon with myself at the New York Economic Club.
Absolutely grilled.
And Fed Vice Chair for Supervision Michael Barr at 12:15 a.m., which, Tom, I know you're interested in to understand this whole banking response and potential stress. And today, this is an interesting one to watch. European leaders are meeting in Granada, Spain, to discuss Ukraine aid. They're also speaking about migration, enlarging the EU. But this is their first meeting since they announced the probe into Chinese electric vehicles. So how much do they build on this, especially in light of a rather fraught tension right now with the U.S. with respect to aid to Ukraine and just understanding exactly how they're going to move forward economically?
Back and forth with Leslie Vinjamuri, who's going to join us this morning. And I just wonder if all the intelligent discussions of EV and the rest completely overwhelmed by the migration discussion.
I think we're all just haunted by meetings of EU leaders going back to the
You
Eurozone.
lived them. I've never been to one of these meetings. It's like watching paint dry, right?
No, thank you. Eric Friedman, CIO at US Bank Asset Management, joins us now. Eric, wonderful to catch up with you, sir. Lisa mentioned Barclays. Only a stocks crash can rescue bonds. Eric, do you agree with that?
We don't, Jonathan. Good morning, everybody. I'd say that our view is that the economy is still in a good place, not a great place. And so we think that there's probably a incrementally, let's call it modestly positive news is probably enough for the bond market to settle down. So take, for example, this morning, you had revisions to July exports from Germany. You also had a worse than expected, current print from exports in Germany. That's given the European equity market some degree of relative calm. So I think more data points that are incrementally flat to slightly negative is probably enough to get the bond market tamed, as opposed to that let's call it the Minsky moment where, we wake up and something really bad happens. We just think that there's other variables will get rates to settle down, not that really bad cataclysmic type of action.
Eric, we can't leave that there. Are you saying the ideal data point is one that is just slightly negative? Not bad, not good, not great, but just slightly negative?
Let's call it slightly worse than Goldilocks, Jonathan, would be the rule of the day. So, for example, this Friday's job print. If we see something that's like 250 versus the expectations of sub 2, and we see a fanning out of job filling, if you will, that would be viewed as more concerning. So I think that this is an economy that is still in a good place. I don't think that we can really move past that. That the data is certainly incrementally getting worse, but it's still from a very, very strong level. So that gradual wind down of positive news, we think, is sufficient to get things to settle down, as opposed to that sort of knee-jerk reaction.
Eric, critical question here with the bond hemorrhage we're seeing. I noticed the Keefe Bruyette Bank Index, by some moving average measure, I got it down like 45% or whatever. Is this a time to diversify? Do you want to diversify here, or do you want to be more focused in sector selection?
Yeah, Tom, our viewpoint has been really to have a 60-30-10 approach to laddering duration. I'll talk about diversification in just a second. So that means that if you own a good pool of bond assets, have 60% of that in the sub-2 range in terms of duration, years of duration, 30% the 2 to 7 curve, and then it's called 10 out. I think that from a diversification by sector standpoint, you're really not getting paid to own investment-grade corporate credit versus treasury. That's not really a high conviction area. We do think there are spots like non-agency mortgages, which is not some esoteric part of the bond market. You can access it through lots of different ways. That's a spot where you're picking up some coupon. You're also not taking.
Okay, but what about an equity?
So,
what about an equity? Everybody's like, equities have done great. They're not getting hammered like bonds. We're going to spend the whole morning looking at price down in bonds. In equities, are we going to enjoy price down? And do I diversify or focus my sector bets?
Yeah, I think price down modestly over the next couple of let's call it a quarter, Tom. So that gives you a chance to do a couple things. One, we've been saying trim tech. It's been a great winner. Obviously, everybody knows that. The earnings momentum is there. Expectations are a little lofty for Q1, Q2 of next year. We'd still be overweight technology over a longer time period, but we'd be trimming back some of that excess return. The second area that we think is really attractive is energy. This is really, again, it was the darling last year. It is actually at a very, very important technical level right now. If you look at a variety of different things, whether it's XLE or other variables, we are sitting at some really key levels. So understanding what we look into earnings season for energy market is still that discipline from corporations they've really been forced to by shareholders. So energy is interesting. The other variable that I think is also key is what happens with utilities, that boring, sleepy old area that, of course, is tied to the bond market, is also seeing, again, multi years of support at current levels. So those are really, we think, key variables to pay attention to. But we'd still be involved in tech. We think healthcare long-term makes sense. We'd be, again, paying close attention to energy with a solid fundamental underpinning. Utilities, some key support levels that investors should really pay attention to right now.
What part of the cycle do you think that we're in right now, economically speaking, if you aren't going to lean into bonds, but you are going to lean in potentially to utilities and some other areas at a moment where tech, you think, maybe needs to be trimmed?
Yeah, we think we're in that part of the cycle, Lisa, where there is going to be a gradual slowdown. Again, we are not calling for a recession. We think that call is premature, given the strength that we've seen, not just in the U.S., but also some, call it, modest improvement elsewhere, even in places like Germany that I hit earlier. I mean, these are not necessarily areas that we think are going to be prolonged in a slump. So this is going to be the shallow slowdown point, we think, of the cycle. There's going to be opportunities to get involved, get invested. And so, this is sort of the part where it's not the end of the credit cycle. This is a bit of a midpoint bump, if you will. So that's the spot that we think is a decent place to, again, rotate out of some of the winners and think about some of those sectors that have been a bit more maligned.
Eric, thanks for joining us today. Appreciate the update. Eric Friedman there of US Bank Asset Management. Looking at energy. Let's look at energy right now. Crude, WTI and Brent. Pulling back just a bit this morning. Pulling back a lot yesterday. 83 now on WTI. Had a little look in the last month at 95, all the way back down to the low 80s. We're negative this morning by 1.26%. Yesterday, the biggest one-day drop going back to last year on WTI crude. Bramo, gasoline demand. Looks like that's taken a hit. We talked about stockpiles at Cushing. They're starting to go in the other direction, maybe starting to rebuild. Have we hit a little bit of a demand soft spot here that's starting to play out negatively in commodity markets?
You know, I can't answer that question. It's a really good question, especially given the fact that a lot of people are saying that demand destruction may not kick in until much higher in the price point simply because of inflation. But interestingly enough, gasoline prices have been coming down in the U.S. if you take a look at that. So if you think about these pressures, is this coming off in disinflationary? Good news. But yesterday's move is really something in the crude market.
I don't make a buy, hold, sell bet here, but I'm looking at Exxon with a 7-8% return per year, totally unacceptable. They've got free cash flow, John, popping pre-pandemic 27 gajillion out to 70 gajillion. I think that's a little bit of free cash flow growth. And yet their 5-year dividend growth is low single digit. I don't, what are they, a bank? You know, is this Game of Thrones? What are we doing?
The stock got to a record high in the last couple of weeks on Exxon.
But, you know, I get the price and all that, but they're not playing conventional securities analysis here. They're in their own la-la land.
Brent this morning back to about 85, 84, 78 yesterday on WTI crude. Biggest one-day drop since last September, lower by close to 6%, negative 5.7%. Yesterday at the close. Looking ahead, someone who likes energy stocks will catch up with Sarah Hunt of Alpine Saxon Woods. We'll do that in the next hour. We'll catch up with Anne-Marie a little bit later this morning as well on her brilliant interview with Congressman Matt Gaetz. The future of the House in Washington, D.C. Everything's a little bit rudderless in the nation's capital at the moment. From New York City this morning, good morning.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
For both of them right now. I'm eager to hear their plans and their vision, but if the House of Representatives goes from the stewardship of Kevin McCarthy to either the stewardship of Jim Jordan or Steve Scalise, that's going to come to the delight of many conservatives.
Congressman Matt Gaetz there of Florida speaking with Bloomberg's Anne-Marie Hordern and Joe Matthew on Balance of Power yesterday. Fantastic exchange. Catch the full exchange, the conversation on Bloomberg.com and on the Bloomberg terminal. If you're just tuning in, this is your market right now. Trying to bounce off session lows. We are negative by 0.25% on the S&P. The bond market sell-off reversing yesterday off the back of a downside surprise on the ADP report. Let's see if that sticks into the weekend. We've got payrolls tomorrow, jobless claims a little bit later this morning. Yields lower at the front end of the curve on a 2-year by a couple of basis points, still just a little north of 5%. On a 10-year here, Tom, down by a single basis point at about 472.
Yeah, we got to, I mentioned again today, John, it's fragile. I still don't have a real yield quote yet. No, well, yeah, sort of I do, 2.39%. I get it that it's calmer out there, but it's got this jitter to it. You know, and off the economic data, we'll see.
This week has been about the data.
Yeah.
To some extent, we can argue to what extent, but to some extent.
We have further
We had decent data Monday, decent data Tuesday, back-to-back double-digit gains on a 10-year yield, and then things turned around on a softer ADP report, which I think speaks to the kind of moment we're in at the moment.
Lisa, in your reading, if we disinvert and get back near zero, the difference in yield between the 10-year and 2 years, is there a tipping point? We're at negative 31 beeps. When do we, like, go, yay, victory?
Is that victory or is that
I don't know.
problematic
I'm
if we're
asking.
getting the long end? The interesting aspect of the recent price action, and PJM's Dalip Singh, formerly of the Treasury Department, put it well. It's a price sensitivity, a new price sensitivity of the buyers in Treasury markets. The insensitive price buyers are kind of backing away, and that, I think, is the big change.
Right now, we're going to digress here. We've got Anne-Marie Hordern coming up here in the next hour. But right now, we are thrilled to bring you one of the voices. This is something we're really trying to do in this U.S. hysteria, is get deeply experienced voices, not of calm, but maybe of possible reason. That will be Leslie Vinjamuri, head of U.S. America's program at Chatham House, a wonderful migration from Wesleyan to LSE to Parchment at Columbia along the way. Dr. Vinjamuri, thank you so much for coming from London just to see us this morning. What a mess. We've gone over the history lesson of it. Forget about it. Let's move forward. I'll talk to Anne-Marie about this. 4% of Republicans gummed up the works. How did that happen?
Yeah, it's a very strong, powerful minority that has very strong incentives to increase their own popularity and visibility by fundraising by pulling apart at the seams any effort to do what Congress has always done, which is to forge deals that make governance possible.
And John, yeah, my question, John, is what percent of the GOP is Mr. Gaetz just talked about, many conservatives? That to me is the mystery.
Important question. Framing matters. When you ask that question, I think you might get different answers if you're asking Congress and if you're asking voters.
Yeah.
And I just wonder, with that in mind, Leslie, who's Matt Gaetz more closely aligned with? His own party, the people who vote, or his colleagues in Washington, D.C.?
Yeah, and look, it's no longer a party. This is the thing, right? The idea that the Republicans are a unified party, or frankly that the Democrats are a unified party, is really vastly overstated. It's a fringe of the party. We've seen this happen. And so, you know, looking ahead, it will be very interesting to see. If you look at public opinion, right? The American public, Republicans and Democrats, they want their government to stay open. They actually still support funding for Ukraine. They want some border security. Will we get people in Congress to do what they've always done, which is to override this very radicalized, vocal minority on the far right of the Republican Party and do some deals? And we are seeing some senators try to do that. Schumer and McConnell are talking about this on Ukraine aid. But will they have the ability in the existing rules? That's going to be extremely difficult. We're in uncharted territory.
The Democratic playbook right now seems to be to allow the Republicans to just have their fight, have their squabble, and shoot themselves in the foot and back away and just take the high ground. Do you think that they're going to bear any of the responsibility for the kicking out of Kevin McCarthy by not backing him?
You know, a number of people have come out and said the Democrats, by voting with, have, in a sense, contributed to the problem. Whether the American public reads it that way, I think, is much less likely. And we know when it comes to, you know, where do you really pay the price? You pay the price at the ballot box. And this is, you know, the vote isn't taken collectively. It's taken on the basis for individuals in their individual constituencies. So, will those people really pay the price? Very hard to see that happening.
You mentioned Ukraine. President Biden has made a number of comments indicating that he has other avenues to get funding to Ukraine outside of going through Congress. Do you have any sense of how deep those pockets are, what that funding possibly is?
Yeah, I mean, the first thing is, there is going to be a very significant and very important public relations campaign to drum up support. President Biden has said he's going to make a speech. He's certainly looking into existing funds to see what can be transferred. But, we've also seen, very interesting yesterday, this reporting that President Biden has decided that he will support the border wall, that he's lifted restrictions, state restrictions in Texas to make it possible to allow some of that border wall to go forward. So that is a sign also that this is a president who is going to be thinking about that compromise. And a lot of the compromise that's going to be on the table when we get to renewing funding to keep the government going is going to be about border security and Ukraine funding.
Let's not underplay this. You are the definitive Chatham House voice, transatlantic. You've written on this and you've thought about it. John, remind me, where are the EU leaders meeting? Leslie's not there, but hey.
Granada, Spain.
Granada, Spain. We're in Granada, Spain. There's this. Lisa mentioned EV vehicles. Baloney. There's only one topic. People on fragile boats crossing the Mediterranean. Same thing here. They're crossing the Rio Grande. There's a primal scream, including the governor of Illinois, saying to the Democrats, wake up. Do you see any indication the Democrats will wake up?
Well, I think what President Biden said yesterday, right? This is clearly a president who is looking, he's understanding that a lot of the electoral pressure is going to be, if you look at the issues that Americans care about, migration is very high, and it will play more and more as we move into primary season. And so, yes, I think that there will be increased sensitivity to this from the Democrats.
Mayor Adams is going to the 6th borough of New York City today, isn't he? It's not the Bronx, it's not Staten Island itself.
He's going down to Mexico, he's going down to Latin America.
What's he going to do down there?
Leslie, we spoke to the governor of Connecticut, and he said a moderate is a liberal mugged by reality. Are the liberals being mugged by reality on this topic?
I think that, again, this is a very tricky calculation. There is a timing question. To your question about Europe, same thing, right? That there, we've just had the Conservative Party conference in the UK. We've seen Suella Braverman and others playing to the far right on the question of migration. There is a desire by others to be more moderate, but as the far right becomes more powerful and as the numbers become more visible and more significant, whether it's the Mediterranean, whether it's the southern border, yes, of course, the liberals are going to become more sensitized to this and take it seriously. And again, I would point to the announcement coming out from President Biden, the idea that he's going to actually commit to something that he said he wouldn't, which is to investing or allowing progress on the border wall, is a very significant development.
What does that tell you about how much has changed? Is this really a far-right issue?
This is an issue that the far right has been very effective at putting in the public domain. There are a number of issues, and it's sort of a grab bag of issues, not to underemphasize any of them, but what actually gains traction, it's very much about who manages to mobilize and bring them up front in the media and elsewhere. So it is an issue that has been very significantly understated. But again, there's a question of, is it an issue, and how do you deal with it? What's the policy to deal with it?
Leslie, appreciate the insight, the opinion this morning. Thank you. Thank you very much. Leslie Vinci-Murray there of Chatham House. What's that, TK?
She should move to New York.
Maybe she likes London.
Chatham House West.
Chatham House West.
Yeah.
Okay. Are we done?
I'm done.
Good. Jens Nordvig, Exante data on the FX market coming up very shortly. Some big moves in the FX market. Dollar dominance has been the story over the last couple of months. 11 weeks of dollar strength against a weaker euro. Can we make it week 12? Will we? That conversation coming up next.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Equities on the S&P 500 shaping up as follows. We're pulling back just a little bit this morning by 0.25%. Decent day of gains yesterday on the S&P, on the Nasdaq too. Best day of gains since mid-September on the S&P, since late August on the Nasdaq. And you can thank the ADP report for that. A downside surprise on ADP, the appetizer for the payrolls report on Friday, sparking a big move in the bond market. Bonds rallying, yield to lower. This morning, you're lower again by about 2 basis points on a 10-year to 471.44, down about 3 on a 2-year here, just north of 5%. To see the 30-year briefly yesterday, Bramo, breach 5%, all the way back down to 486.28 this morning.
I take Tom's point from earlier that it's unclear exactly what's behind this, but it does feel like the one takeaway is this isn't a rip-roaring rally. And that to me is telling, because of all the bond bulls out there, sort of like Ian Lingen yesterday, they're not coming in whole hog. There still is this reticence to really embrace any kind of stability in the market.
You brought up Dilip Singh, and I think it's an important point that Dilip is making. The absence of predictable buyers on the demand side.
Yes.
It's a very, very different story. You can't depend on, you mentioned the central banks, can't depend on that anymore. Can you depend on China anymore? Can you depend on that foreign bidding quite the same way? And I think that's why there's a lot of head scratching going on. Some people might sit in the chair across from you, Bramo, and say things like there's a buyer's strike. But I think the way Dilip framed it is a little bit more sophisticated.
I would say so. Basically, that there used to be a price-insensitive buyer base, and that included the central banks of places like China, like Japan, as well as a lot of investors. Suddenly, people are waking up to price, and they are becoming much more sensitive to that, even in some of these institutions. That is the sea change, and it is structural.
And this goes to our guest that's coming up hugely, and everybody pay attention to this in Global Wall Street, Jens Nordvig, in a bit. John, I don't want to show the chart because it's got too many lines. People will drop their coffee cup on TV. They'll drive off the road on radio. But the bottom line is, on some of these charts, I'm out past 5 standard deviations. I looked at a Japanese chart today, really sophisticated chart, back 32 years. We've never seen the move ever bottom to top in standard deviation, and I believe it was the 10-year piece in Japan. It's a 5 standard deviation traipse, if you will, to a higher yield in Japan.
Thanks again to the bond team, the bond desk here at Bloomberg for these numbers. The 30-year bond, Tom, has tumbled 53%.
The U.S.
U.S.
I did not know that.
53%.
Yeah,
that's how bad the price destruction has been.
And we opened with the United Kingdom, where I'm going to guess it's worser. Because you got 1998. You got
really difficult stuff. Let's turn to foreign exchange and just wrap things up for you. The dollar's showing a bit of weakness just yesterday against G10 this morning. Looking at the euro at 105.16. We're positive on that currency pair by, let's call it 0.1%. Under surveillance this morning, initial jobless claims due at 8:30 Eastern time. Our survey expecting a print of 210,000 claims, a slight uptick from a week ago. The report coming after ADP data showed US companies adding the fewest number of jobs since the start of 2021 last month, pointing to a slowing in labour demand. The US payrolls report for September due tomorrow morning. We talked to Andrew Honhorst, the City leaser, as soon as these numbers came out yesterday. Does it change anything for you, Andrew, on Friday? No. He's still looking for 240.
And he's still looking for the unemployment rate, I believe, to fall to 3.6%. So in the wrong direction for the Fed, the right direction, I guess, for people who are in the labor market. But this really is the tension. ADP doesn't matter until it does, as we've talked about many, many times. Yesterday, it confirmed the hope and the dream of markets that we're going to get an ongoing disinflation. If you do get confirmation of that today in the initial jobless claims, do we see more conviction in this rally? Do we see a greater conviction ahead of tomorrow's print?
I can't go there technically. I mean, I get it. We had a nice, John, what'd you say at the opening of the show? NASDAQ up most since 1990, whatever. You know, we had a nice pop.
Since the end of August, but we can pretend it's 1990 whatever if you want.
That's great. Okay.
You want to make it more extreme, go for it.
It's theater. Let's do it.
Facts don't matter.
The answer is it's a one-day pop. We're going to get to this with Jens, his phrase. The bond carnage now is just FT has a wonderful article today on sovereign carnage. Carnage. That's the EP phrase.
Jens joining us in just a moment. A government shutdown next month looking even more likely as the fallout from Kevin McCarthy's removal of House Speaker continues. The House needing to find resolutions on key spending measures, but unable to do so until a Speaker is chosen. Florida Republican Matt Gaetz telling Bloomberg's Anne-Marie Hordern and Joe Matthew he's backing bids from Congressman Steve Scalise and Jim Jordan to replace McCarthy. Bramo, what's next here?
Honestly, a shutdown, because it doesn't seem like there's really any expectation.
People are
Certainly
predicting
not
that,
Jim
right?
Jordan.
Sure.
People are predicting a shutdown?
Yeah, I mean, honestly, Jim Jordan is probably doesn't have the mainstream votes, maybe Steve Scalise, but to get some sort of coalition at this point, given the animosity right now within the own party, let alone just generally in the House, yeah, basically we're going to be heading for a shutdown.
The story of the last 24 hours, nothing else matters.
No.
Walmart saying it's seeing an impact on shopping demand from people taking Ozempic and other appetite-suppressing medications. The retailer CEO saying this: we definitely do see a slight change compared to the total population. We do see a slight pullback in overall basket, just less units. Tom Keene, slightly less calories. What a change. Just how fundamental the shifts we could see in this economy of one drug.
Okay. Medically on a free lunch, I need somebody really qualified in medicine to tell me this isn't a free lunch or there's a cost on the other side to what is clearly a miracle drug. I mean, I just don't...
It's going to transform potentially the whole of this economy, which has been
yeah.
shaped around an obesity epidemic in this country.
Well, it is
we talked
an
about
obesity,
airlines
to be
earlier
serious,
this week.
it is
Talked about
obesity,
airlines earlier this week, which could save on fuel. This is really no joke. Look at Walmart as well. And some of these companies, you talk about adjusting and adapting. Some of these companies, Bramo, are going to have to adjust and adapt to this.
It is a fraught moment when you have companies that sell food that might not be completely healthy, seeing how they can offset the decline in sales of said calories because people are eating less. It creates a really fraught medical moment for the social discourse and a PR move as well.
John, we've got to inform our people. Lisa Folks does a half marathon every day when she leaves the office.
I thought you were about to say you started Ozempic. That's what I thought was about. I was waiting for this big announcement.
Lisa is so biased on this. She runs a freaking half marathon 4 days a week when she leaves the office.
Just getting confirmation from the team that we'll catch up with Jen Bartashis on this story in about 10 minutes' time.
Wonderful. Expert on the big box theory. Right now, expert on this linkage of foreign exchange into the bond market. It is the 10th anniversary of his truly important book on the euro, The Fall of the Euro. Jens Nordvig, with tours of duty on Wall Street, runs his own shop, Exante Data. They are definitive. We're thrilled he could join us this morning. Let's link it up here. You call it a bond carnage. How do you link that up to the dollar and foreign exchange?
When we have the bond market moving in a dramatic way, you always want to go and see, okay, what is kind of behind it, right? Is it the inflation expectations that are going up? Is it something to do with better growth, or is it something else? And I think on this occasion, we can definitely rule out inflation expectations, right? We've had very stable inflation expectations over the last couple of months. You can even argue that, you know, the realized inflation has come down, right? So really it's an issue about, okay, is there something with growth that's better, or is it really supply, right? And if I look at what's going on in the yield curve, we can see it over the last couple of weeks, like all the big moves have been driven by the long end, right? That doesn't smell like growth, right? If it's just growth getting better, we will have like actual tightening being priced into the short end. So it's the long end driving it. The other thing I would say is if you look around the world and look at growth indicators, I'll just pick a very simple one. Like look at what's going on with copper. Copper is now at an 11-month low, right? That's typically viewed as a very basic growth indicator. It's definitely not flashing something particularly bullish, right? So we have this situation where the US yield curve is shifting dramatically higher in real yields, not totally clear that it's growth related. It's something to do with the repricing of the curve, right? Maybe it was too inverted in the first place, right? And that real yield increase has been really boosting the dollar in all crosses. But it's not just the yield curve itself. It's also because these higher yields are starting to spread into credit, starting to spread into risk assets, right? So we having a big kind of risk reduction wave here over the last couple of weeks. It's not like a total panic,
right?
But it's broad-based.
Jens, I did my inner Jens Nordvig yesterday. I took DXY as a Plaza Accord proxy, and I figured out the DXY's got to really, really pop to get back to the tensions of the early 1980s. Do you frame dollar at a peak right now, or can dollar extend stronger out to those tension points?
So what we're focusing on day and night is, okay, this, growth outperformance that you have had in the U.S. and also, core inflation, service inflation, staying more sticky than other places, what is keeping the Fed in this hawkish mode, right? So as long as the Fed is more hawkish than the ECB, other central banks, it's going to be hard for the dollar to turn, i.e. turn weaker, right? And the other thing is that global growth is pretty soft. That also tends to keep the dollar strong. But the level of the dollar is very elevated. We're getting close to the peak dollar levels we had last year in many crosses, right? The question is, can we really go past them? Keep in mind, last year we had a full-blown energy crisis in Europe. That was what took the euro below parity, right? That's not the same at this point in time. So I think for the euro specifically, breaking to new lows will be hard. It's not the same situation. But at the moment, it's really about whether the Fed stays in hawkish mode. We can also see it, like, just think about the price action yesterday. The yield curve is very much correlated, long end and short end. And when you have weak data points, right, the whole yield curve rallies hard. So the market is looking incredibly hard all the time to find some sort of signals that the U.S. economy is turning and the Fed can change. And just one final comment on that. Financial conditions in the United States have moved dramatically tighter over the last 3-4 weeks. And the Fed has not really talked about yet. So one way we can also get a shift in the yield curve is that the Fed actually says, okay, actually financial conditions have tightened substantially, and that's going to impact our policy. They have not been willing to say that, but given the size of the move in financial conditions from bonds to credit, equities, the dollar, and so forth, all that, I think we're getting closer to a point where the Fed will have to acknowledge that there's something more significant going on in that space.
Hold on a second, Jens. What you just said there is really interesting, especially in light of what Barclays analysts were putting out there, which is we need a huge sell-off in risk assets to get the bond market to rally. Are you saying we're close to that already?
I think if you look at the size of the move we've had over the last month, right, this is one of the bigger ones. And we've not had anything like this since, 13 months ago when we had that big risk off that everybody still remembers. So the Fed is reluctant to say something about it too early, right? Because in a way, they've been surprised that bond yields were so low and so much lower than the 2-year rate. But now the curve is flattened dramatically. Credit is definitely on the move, right? So I don't think we need much more financial conditions tightening before the Fed will definitely have to embed it and definitely say something about it. And that's a new situation we've not had for 6-9 months, really. Really since the Silicon Valley Bank shock, we've not had any talk about that.
We've had a 150 basis point move on a 10-year since the SVB lows, post-SVB lows. Jens, thank you, sir, as always. Jens Nordvig there of Exante Data on the Fed and whether they weigh in on some of this. Later on today, Mester Kashkari Barkin, Bar. You're going to hear from Waller tomorrow for whatever that's worth. And Daly a little bit later with Bramo. Mary Daly, I know where you're going with this conversation at the top here, Bramo. Mary Daly on this bond market, are they willing to talk about it, or are they going to take the Goolsby line of things with Joe Weisenthal and Tracy Alloway, which is, I'm puzzled. I'm puzzled by it.
I'm puzzled and watching, but not necessarily materially changing his outlook or his guidance as a result. At what point, to Jens's point, does this change the view of the FOMC when it comes to raising rates again, but also what the threshold is to cut rates going forward?
You want a dynamic? SRI has a SRI index, Sri Natarajan, our ace reporter. Lisa, before this carnage, JP Morgan was 15% greater market cap than Bank of America. It's now 100%.
But is this an issue of stability or is this an issue of profitability? And that's a really important point.
Maybe both.
At attention.
Mr. Barr cares about stability. That's what I'll listen for today.
Earnings 2 Fridays away. Coming up, why Ozempic might be changing spending
You're just
habits.
not let off. Why are you looking at me every time you
I'm
do
looking
that?
straight down the camera, not even looking at you. From New York City this morning.
Are you saying something?
Good morning.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Market is looking at this move and saying it's temporary. We're going to have dip buyers come in and we'll reset to lower rates. What I worry about is if this sell-off ends up being sustainable. Envision a world with 10-year yields above 5% for a sustainable period of time.
Ian Lingen of BMO, just one of the best on the street for fixed income strategy. I have to say, almost sounding spooked by what he's seen over the last month. At one point, he called it a screaming buy. I should also caveat by saying I asked him if it was a screaming buy, and he said he thought it was a screaming buy. And Lisa, here we are, something like 50 basis points later on a 10-year, doesn't want to get away of it, in the way of it at all, does not want to step in.
I think a perfect time to stay on the sidelines was the phrase that he used, which is a very big divergence from screaming buy, which maybe you initiated, but either way, he took the bait. This is the question that I have. At what point are we looking at just technical levels and then a rip-roaring rally, or a structural change akin to what Dalip Singh was talking about over at PGIM, where price-sensitive buyers are really the ones out there? The insensitive buyers are not in existence anymore. People are looking at levels and they're looking at getting compensated for the risk.
We've lost that predictable demand. Maybe Walmart has too. Take a listen to this.
Good segue.
Do you like that? Thanks.
That was
on the spot as well. I'll take that. Let's get to this quote from the Walmart CEO saying this. On people taking Ozempic, had this to say: we definitely see a slight change compared to the total population. We see a slight pullback in overall basket, less units, Tom, slightly less calories. How things are changing at the biggest retailer in this country.
Yeah, when I look at Walmart and, I look at my Ozempic, I look at John Thin 30 probiotics for weight management, the Green Select Phytosome in Thin 30. It's an all-natural caffeine-free green tea complex that has been clinically shown to have an impact on weight loss and maintenance. Tom King, you should try this today. That's Walmart selling me.
Someone emailed you that?
Yeah, well, no, they emailed me. Yeah, Mrs. Keene, $27.97 per bottle, and that's the industry that is there when you walk into Walmart.
The weight loss industry.
Yeah, why don't you bring in Jen here, because you're really on top of this thing.
Jennifer Pantasius,
I'll take my Thin
Senior
30
Packaged Food and Retail
probiotic.
Staples Analyst at Bloomberg, joins us now. Jen, great to have you with us on the program. Fantastic as always. Just walk us through how much detail the likes of Walmart has on something like this, how they can track shoppers to find out these things in real time.
It's fascinating, and this is really the new era of alternative and big data in action. But the first thing we should say is that Walmart isn't tracking individual people and what they're taking and what they're buying. Instead, they're looking at groups of people on an anonymized basis, and they're saying because they have such large pharmacy operations, they can look at how many prescriptions are dispensed, and then they can look at that group of people who are on a particular medication and analyze their spending habits across the store. And this is really indicative of the health and wellness pivot that a lot of these bigger retailers have been making over the past few years.
How big a slice of the overall shopping base of a place like Walmart are Ozempic takers? I guess, Jen, that's what really matters here. We can track Ozempic, people on Ozempic, and we know that they're pulling back average basket units, calories. What are there in the overall pool of Walmart shoppers at the moment? 5, 10%?
Well, I don't think that they've actually disclosed how big that is. It's still a relatively small percent. But when you look at the overall health profile of the American public, the use of drugs like Ozempic or Mounjaro or some of these other weight management tools is growing. There is a health crisis in this country. And so we would expect that group of people that are on drugs like this is only going to grow, and which is why these retailers are paying close attention now.
I'm just sort of speechless on this. Jen, what are the side effects of Ozempic? I mean, is this one big free lunch that's going to change your world and all of our worlds?
Well, I'm unfortunately I'm not a physician. I can't really speak to the specific side effects. But when the purpose of these drugs is to help regulate your blood sugar, it's to help regulate your hunger levels. And so if they are effective for individuals, then that will play through in your shopping behavior. And so, people who are focused on losing weight historically have tried to change their patterns. They buy more vegetables. They buy fewer processed foods. And, that's a long-term trend that will probably continue to play out as we see more and more people benefiting from some of the drugs that are out there.
Jennifer, I want to just throw out some statistics. Morgan Stanley has been crunching the numbers. They expect that 24 million people, about 7% of the U.S. population, will be taking some sort of weight loss drug similar to Ozempic by 2035. They estimate that these people could cut their daily calorie consumption by 30% in that time, which is a survey of patients who are currently taking it. How much is this going to be a bit of an issue for some of companies that have kind of designed themselves in the retail business around the snacking culture, around bags of chips, around soda, around all of the types of foods that people are cutting out?
That's a fantastic question, and that is where you see companies like the brand new Kellanova, which is branding itself as a snacking company, taking a closer look at some of these trends. One of the things that when you look at companies like Kellanova or you look at Mondelez, they have initiatives in place that are focused on smaller pack sizes. So 100-calorie packs, things that are a little bit more where you can still indulge, but you're much more conscious of your calories. And so we're likely to see an acceleration of that sort of tactic from these packaged food players in response to people trying to manage that caloric intake a little bit better.
The tactic that really was coming after a whole decade, many decades of growing up with a snack culture. I'm just wondering how awkward it is of a moment, and from a PR perspective, for some of these companies to come out. They have to embrace kind of the healthier eating, right? Even though they have grown out of kind of the opposite and just buy more, eat more, do more, and that is part of the problem.
It is, and you know, that's where, you know, so some of the more subtle, you know, indicators over the years, you know, reduced sugar, lower sodium, you know, these are things that these companies are going to fall back on and say, you know, we've been thinking about you for years now. You know, whether that's, you know, how much people believe that or not, but that's one of the messages that I would expect that they'll amplify, you know, as this goes on. But let's not forget there's a whole other segment out there, which is fast food, you know, which could also be impacted by these you know, the taking of these kinds of drugs.
Some of these numbers are amazing, Tom. 26%, this is the Morning Consult poll, 26% of US adults said they're interested in taking drugs like Wegovy and Ozempic for weight loss.
Okay, so Jen, I mean, you folks, we're underselling it. Jen is encyclopedic on this, and particularly big box retail. Excuse me, Pepsi is, I'm gasping because I missed my Ozempic this morning. Jen, Pepsi is selling into Walmart. They're having a meeting at Frito-Lay this morning going, what do we do? Jen, what do they do?
Well, you know, I think that for retailers like Walmart, you know, and these big package companies like PepsiCo and others, it's about having a conversation, and it's about how you find, you know, mutual benefit out of the products that you have, where you're going to choose to do promotions and marketing, and how you're going to let the consumer know that there are parts of your brand portfolio that can meet their needs, regardless of what your individual focus is. So there are going to be people who don't care what they eat. They'll eat as many calories as they want. But for people who are on some of these drugs or who, you know, are looking to lose weight, you know, this is where this, you know, idea of personalization and you know, floating things up to customers based on their other patterns comes into play. And so it's really going to be a collaboration between the brands and the retailers to position products in the right way for the right customers at the right time. And that's the pattern that we've been seeing when they're talking about their approach to, you know, how they're going to be doing marketing and personalization and all that type of work going forward.
Hey, Jen, wonderful to get your insight. Jennifer Bartash is there of Bloomberg Intelligence. A lot of this stuff is like the next decade, the next 5 years, the next 15 years. Futures now. Barclays in the last week recommending shorting fast food credit. Ramo, because of Ozempic.
If you talk about a 30% decline in caloric intake, and you talk about a wide swath of people who probably may disproportionately frequent some of these outfits, you are talking about a real loss of potential revenues. I just am wondering, you know, how you extrapolate out who's going to take it, how they're going to take it, what else is developed, and then what does this do to a model that was really built out of a snacking culture, eating quickly?
Well, you know, I don't know about the Abramowitz house. The Bramwell house, you won't let me go over, folks. It's just totally green, you know. It's gluten-free and all that. At my house, they're chowing down Doritos salsa verde. I ate one of them the other day, and it basically was eating a spoonful of salt.
I walk into your house and I bump into a bar cart as soon as I go in.
The bar cart?
Yeah.
Yeah, but the bar cart's got wheels, so we can move it out of the way.
You can really just keep moving it
that's
along.
No, but seriously, do you have Doritos Salsa Verde at your house? Bags of that stuff?
Not a huge fan. I don't like
Doritos? Absolutely not. Coming up, Sarah Hunt of Alpine Saxon Woods is going to be joining us. Doritos. At Ramos, at mine, no chance. No chance.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate
if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
We see this steepening, and I think that should give investors pause and think that really there is a fiscal risk premium coming back into the Treasury market.
One of the reasons Treasuries are so high compared to other parts of the bond market is simply there's such an enormous supply of Treasuries.
For all intents and purposes, there's a buyer's strike in the Treasury market.
Obviously, we're focused on that 10-year, right? The 10-year needs to stabilize. Everyone's watching that.
The fact that 10-year yields are higher, I think, is probably consistent with what the Fed is trying to achieve.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a month it's been for the bond market. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market trying to stage a recovery this morning. Off session lows negative by 0.1%. Really decent day of gains on the S&P 500 yesterday. Pushing ahead now to payrolls Friday just around the corner. Jobless claims TK a little bit later this morning.
The eco data is important. Lisa's going to have that. And I think it's really, really germane to the debate forward for the Fed and for Fed speakers. Mary Daly with Bramo today. Must listen, must watch at the Economic Club of New York. John, 4:53 a.m. this morning, the 2-10 spread popped 30 beeps to a 29 handle. We have massive disinversion still going on. This isn't over. I look at the screen. I'll take your point. It's calmer. That's all.
It's all led by the long end, the 10-year and the 30-year over the last month. I know this morning might be a little bit different. Looking ahead to that Facebook, Lisa, Mester, Kashkari, Barkin, Bar, and you've got Daily. Do they start to talk about what's happening here in this bond market?
They kind of have to. They've been tiptoeing around it a little bit, but there was an interesting story in the Wall Street Journal, talking about how on the margins, the bond sell-off does threaten some of this discussion for a soft landing because you're seeing conditions tighten very dramatically on the long end. Do they lean into this? This is incredibly unusual at the end of an economic cycle. Usually you see bonds rally on the long end as people expect there's to be some sort of downturn and for Fed rate cuts to come on the wake.
I don't want to steal your brief here in moments. I know you're going to mention it, but Michael Bartamy is the key voice today. This is about the banks, Lisa. It's about October 13th when J.P. Morgan trots out. Let's assume J.P. Morgan made all the right decisions. Lisa, their market strategy is unfreaking real. So they're going to do market strategy. They're going to get the bond market right. I get it. But guess what, Lisa? There's other banks out there that are really going to have troubles.
This is what people are looking for, is some sort of circuit breaker that can come in and to cause a real renewed rally in bonds. And John, that's really the question. If there isn't that circuit breaker, then do we end up in a higher yield environment that is very different to anything that we've gotten used to over the past couple of decades?
Outside of bonds, what is the market telling you about the economy right now? Spreads are wider, bank stocks are lower, discretionary sucks. That's not the year, that's just the last month so far. Isn't that telling you that outside of bonds, the market's starting to think about that weakness now in a way that it hadn't a couple of months back?
Absolutely, and the overall index has been buoyed by tech stocks and by this sort of preeminence of artificial intelligence. You're right. But that's kind of by design. It's actually a feature, not a bug. So if we end up seeing it accelerate in an unruly way, that's when the Fed will care. Other than that, isn't this exactly what they've been trying to get the market to agree to?
Key point. We've gone restrictive. The Bloomberg Financial Conditions Index is going to a negative statistic, which is finally overtly restrictive. And you get back to Dominic Constam's phrase, super restrictive.
Couldn't agree more. It is the objective right now. Let's get to the price action. Equity futures slightly negative, softer, down by 0.1%. Yields come in a couple of basis points. We're down 2 to 471.44 on a 10-year. Crude oil having a really rough 24 hours, down almost 6% yesterday, down 2% this morning. Lisa, 82.54 on WTI.
That's one of the biggest mysteries, I think, out there when you say looking outside of bonds. What we are looking at as well as the economic data, will it confirm the weakness that John was just talking about? 8:30 a.m. we get U.S. initial jobless claims expected to tick up, but every time we've been expecting them to tick up from very low levels, they have continued to go down. So we shall see. Today we do have a slew of Fed speak. You've been talking about it. Cleveland Fed President Loretta Mester, Richmond Fed President Tom Barkin. We have Neil Kashkari. We have San Francisco Fed President Mary Daly at noon at the Economic Club of New York, and Fed Vice Chair for Supervision Michael Barr at 12:15 a.m. Yes, I'm curious about what Michael Barr has to say, but more so, is there a theme that starts to develop between all the Fed speakers and how they are looking at some of the moves that we have seen in longer-term bonds? And today in the EU, this is really also a very interesting moment for aid to Ukraine, for the whole European-China tension that spat. EU leaders are meeting in Granada, Spain. They're talking about Ukraine aid. Curious to hear what they have to say about the U.S. Also migration. Also, this is the first meeting since the bloc announced its probe into Chinese electric vehicles.
Emery Horton with us this hour. She sent me a note that Biden is also looking at Ukraine with great focus today.
Going to get a speech, aren't we, on Ukraine aid?
I think so. I don't know.
I think that's what a lot of people are expecting. Sarah Hunt joins us now, Chief Market Strategist at Alpine Saxon Woods. Sarah, good morning.
Good morning.
I always go to energy with you at the end of the interview. We should go there at the start. Crude was dreadful yesterday, down almost 6%. I know that things at Cushing looking a little bit better on the stockpile side of things. Gasoline demand really soft as well, based on a recent read. What do you make of the recent moves?
Well, I mean, we talked about this last time. If crude prices rise really quickly, then gasoline prices come up commensurately, and then all of a sudden you do have a backing down in demand. And I think part of it was the demand numbers on gasoline. I think part of it is also sort of the parallel to the bond market, which is all of a sudden the market's going, well, if we do have a recession or if the world is slowing down, then crude prices may be too high. And part of the reason they're high is because the Saudis have taken some off the market. It's not just a problem of higher demand and not enough supply. But I think the supply side is going to stay somewhat restricted, and I think that's really going to ultimately be the longer term story. But you are going to have these convulsive moves, and the stocks hadn't caught up, not all of them anyway, to the higher prices in crude anyway. So I think that there is still some room in there, but it is going to be a volatile trade.
I'm calling this Never Ever Thursday because I'm looking at bond charts that I've never ever thought about or imagined or visualized. Mathematically, folks, this is truly, without a cliche, this is truly original territory. How do equity participants react to never ever things in the bond market?
Well, I think it's problematic for the equity markets that you're having such convulsive moves in the bond markets. And I think that part of the issue with equities has always been, if rates do stay higher, what are we discounting those cash flows at? I don't disagree that technology is one of the places that will actually do well, even in a higher rate environment, because you've got that stability of earnings, and they've also got a lot of cash on their balance sheets. But I think that the question of what everybody else is going to do and how that's going to impact people's balance sheets. Corporations in Europe, I read a story this morning on Bloomberg that said that corporations in Europe are finally back breaking down and issuing bonds at higher rates than they would have a year ago. So are people starting to accept that? And if so, that's going to take some of the money out of the income statement because they're going to be paying higher prices. So I think that some of that is going to impact the earnings for next year, and that's still what I don't think is really reflected through next year.
The heart and soul of this is Q4 into next year Do you go with a diversified virtual index fund, tight R squared approach, or are you active and take a less diversification approach? Which is it? I got my own opinion, but which do you think?
I think active. I mean, that's also
active, more narrow.
More narrow,
yeah.
And also looking at where you think there might be some vulnerability, which indexes can't really do, right? Because they are going to rebalance the way they rebalance. And I think that there are some places that are going to continue to be vulnerable.
Do you think that the bond sell-off has been coherent with the other moves that we've seen in the markets?
You know, it's so hard on these very short-term moves to figure out, is this a technical problem? Is this a quant problem? Where is this coming from, or where are these moves coming from? And I think it's very difficult to parse that out and say how it interacts. But I do think that there are large positioning changes. And when those happen, it's not always easy to see. I mean, there was questions about whether or not the BOJ was intervening, right? Because the yen went through, and did that happen? Or was that just a technical level that everybody said, oh, 150, we're getting so close, we have to do something. So I'm not really sure on those very short-term moves how they go together. But longer term, they will start to make more sense. Although, you know, you've had correlations that are very different over the last couple of years than normal. So make more sense as a relative term.
The reason why I ask that is because if yields stay at levels that we're seeing right now, if there is something fundamental behind this or even structural when it comes to price-sensitive buyers, newly price-sensitive buyers, how much does that change the equation for you in the equity sphere? I mean, aside from oil, aside from some of these specific bets, is there a rethink about the value proposition with some of the overweights you've had to equities?
Well, I think that you've been seeing that for the last 2 years, right? Or the last year and a half. Since the Fed started raising rates, the question has been, with or bonds, right? Where am I going with that? Because I'm now putting them back in a portfolio. When you talk about the big price erosion from the lows, when the 10-year was sitting at basically 20 basis points, the fact that we're now up at levels that are over 4, I think people have been looking at that the whole time. But the problem is that as they've been adding the whole time, the prices have been coming down. So there's a little bit of scorched earth on the bond side too, because people have lost money in bonds and in ways that they hadn't in the last several decades. So I think that there is absolutely room for fixed income in people's portfolios. They are putting it back, but that was traditionally where you had some participation anyway. And I think that higher rates make that something that people look at more seriously, especially as duration starts to look a little higher price than it was, because you were sitting high rates on the low end, but on the short end, but not on the long end, and that's starting to change a little bit. Not necessarily for the best for everyone.
Just pulled up a quick chart. Average Fed funds going back to the 70s. Average is 493. I know that's skewed by a decade of zero, but the average is 493. Is anything on a long bond close to 5% just a screaming buy based on history, or can you tell me that things are going to be markedly different over the next couple of decades?
Well, I think if governments hadn't indebted themselves to the extent that they have, then you could look at some of those numbers and say we should have higher rates on the long end, because that was also more historic. But if I think about what that's going to cost governments, I have to wonder whether or not we can collectively keep rates that high. And I'm not sure that we can control the long end as much, but I do think that going back to what we used to think of as more normalized is a little bit difficult, given the fact that we've got this massive amount of government balance sheet that we didn't have 20 years ago.
This is a big question. It's difficult to answer, but what is normal? The last 10 years, the 10 years before that? When we say things like normal, what is normal?
That's going to be, I think, one of the biggest issues playing out going forward. Is the more normal what happened after the great financial crisis, and now that we've gotten this level of balance sheets for governments, do we just stay here and every time we have a problem we just keep adding to them? And does that break something eventually, or do we go back to something that was before that? And I don't know what the answer is, and I think that tension is part of what's going to be playing out going forward in both the bond and the equity markets, because it definitely had an effect on the equity markets as well. You can't say that it didn't with multiples where they are right now.
You can feel that tension at the moment because you get these yields that people have been wanting for a long, long time, Lisa, and there is just that refusal to jump in, both hands, and buy it.
Because people don't understand it. And that's the bottom line. They don't understand how much heft is behind it and whether it's the new normal. And the new normal could be even higher. And we heard that from Margie Patel. Why buy bonds right now if, yeah, we're seeing maybe 4.7% on the 10-year, but it could go to 5, it could go to 6. I mean, why stop now?
471 on a 10-year at the moment, down a couple of basis points. At the front end of the curve on a 2-year, we're down about 3 basis points, still just north of 5%. Let's see if we can hold that level going into claims a little bit later this morning, onto payrolls tomorrow. If you are just joining us, welcome to the program and tuning in. Your S&P 500 is negative here by 0.2%. Yields are a little bit lower by a couple of basis points, 471.44 on a US 10-year. The dollar showing some weakness here. The euro just a little bit of strength, 105.14. Keep going back to the commodity market. Biggest one-day move lower on WTI crude going back to last September last year. in yesterday's session. We're down another 1.8% this morning to $82 and about 70 cents. TK, after we heard all these triple-digit crude moves, these calls over the last couple of weeks, here we are back down to 82.
Maybe it's a discussion of global GDP and, this idea of where demand's going to spin off. I don't know. I'm going to leave that to Will Kennedy and Javier Blas and the team. But I just can't emphasize enough within all this conversation how original a place we are in shifting. John, you had the Bloomberg article, which is hugely responsible today, on price analysis of bonds. There's no other story this morning.
Just to pick up on the crude story, because I do find it interesting what happened yesterday, this idea that we got this massive decline in price, how quickly narratives shift and how exhausting it is. Because one day everyone's talking about how it's runaway growth, reinflation, we're heading toward that. Oh my goodness, China's doing better than bad. All of a sudden oil prices to the moon, and now all of a sudden they're sinking like a rock, most in more than a year, and people are suddenly saying, well, things are cooling down, rates are having restrictive policy. I mean, this is narrative roulette at a moment where people are trying to grapple with some of the potential
6 trading days have gone well over 4 standard deviations in Brent crude.
James Astley of Aberdeen called it narrative table tennis, didn't he, at the start of the year? And
I love that.
It feels that way. Sarah, thank you. It's good to see you as always. Sarah Hunt there of Alpine Saxon Woods. Coming up on the program, AMH down in Washington, D.C., weighing in on the recent drama in the nation's capital. Peter Schitt of Academy Securities coming up in the next hour at about 8 a.m. Eastern Time. All of that still to come from New York City. Stocks trying to stage a recovery. Decent dev gains yesterday. We're down just a touch this morning by 0.2%. Good morning.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
My mission is to ensure that the House of Representatives runs better. If Kevin McCarthy had passed a budget and followed the law to move 12 single-subject spending bills, regardless of whatever's going on, he would still be the Speaker today. It was his unwillingness to do that and his desire to centralize power in contradiction to the agreement he made in January to become Speaker that led us to this moment.
Congressman Matt Gaetz there of Florida speaking with Bloomberg's Anne-Marie Hordern and Joe Matthew on balance of power. AMH coming up in just a moment. This is what's coming up later. Jobless claims a little bit later this morning, 1 hour, 13 minutes away, onto tomorrow. Payrolls Friday. Your price action looks like this. Equities on the S&P trying to stage a recovery and turn positive. We're negative here by 0.2% after a really nice day of gains on the S&P, supported, triggered, sparked by this bond market rally, which continues. Yield to lower by a single basis point. The 10-year 472.27. Tons of Fed speak through this morning. Mester, Kashkari, Barkin, Barr, TK very interested in the Vice Chair of Supervision over at the Federal Reserve, looking ahead to bank earnings in 2 Fridays. Tom, not Barr. Mary Daly, a little bit later at the Economic Club in New York, midday with Bloomberg's Lisa Abramowitz. Look out for that a little bit later. We'll take that. Tom on Bloomberg TV and Bloomberg Radio.
It's going to be an important conversation. Again, let's review that. Let's do that right now. Bramo, to review these troubled banks X number of months ago was on the Daily Watch, right?
Well, the San
As a
Francisco
general
Fed
statement.
was the oversight to the SVB situation. Look, we're at a moment right now where it goes beyond the banks, right? It goes to this question of at what point is a rate at these levels unsustainable for an economy that was built up on, under a low-rate regime? And that, I think, is what everyone's grappling with, including Fed officials.
It's going to be interesting to see. We're going to do this now and jump to her. It's so important. Anne-Marie Horton and Joe Matthew with their important conversation last night with the congressman from Florida, Mr. Gates. Anne-Marie Horton is our Bloomberg crisis correspondent. Anne-Marie, you know, you're at the Capitol Grill last night having a celebratory beverage. I know you're having the in fashion, the Russell Reserve 10-year small batch bourbon, Grand Marnier, black walnut bitters, and other things I can't mention. Can Matt Gates get a drink at the Capitol Grill? What is the reaction of Washington to what he has wrought?
Actually, if you honestly want to know where Matt Gaetz usually likely, I think, hangs out, because I've seen him there before, is the old Trump Hotel, which is actually a beautiful building. It's now no longer owned by the Trump family business. Old U.S. Post Office, Tom, you're ever in town, you should check it out. But this individual is not liked amongst his conference at the moment, and you're hearing a lot of voices say that actually they would like to expel Congressman Matt Gaetz. He is the one that was the driving force behind this motion to vacate. And there's a lot of fire right now and fury within this Republican caucus. Right. And what you hear a lot of people talk about is that this is not going to be wrapped up, meaning who can they coalesce around to be a speaker by next Wednesday. They think this is going to be a long, drawn-out process because the battle lines really within this conference are drawn, and they have such a slim majority. So you can see it's very difficult for the hard right flank and the centrists to really get together behind one name.
News goes on. The president has an active day. Let me do one more question on this. I just think it's interesting. 4% of Republicans get in the way. I think my math is 96% of Republicans don't believe in all of this. Those 96% of Republicans, do they have a favorite for Speaker?
Well, right now it does look like it's either going to be the top 2 contenders would be number 2, House Majority Leader Steve Scalise. This is an individual that is really a fighter. He survived a shooting, an assassination. He's right now undergoing treatment, though, for cancer, but he says he's ready. And then there's Jim Jordan. This is someone who is a big fan of Donald Trump, and Donald Trump is also a big fan of him. He's House Judiciary Chairman. He was a big backer of Speaker Kevin McCarthy. He said to us before that vote, I'm going to support Kevin. I do not want this job. But now with Kevin McCarthy out of the job and out of this speakership chair, it does look, Jim Jordan announced that he will go for it. The issue is someone like Jim Jordan, what does that look like for, say, a Congressman Mike Lawler in the Hudson Valley District that Biden won by 10 points? Is that person too far to the right for him to vote on? And this is why, especially we're a year out almost to next year's election, this is why it's so difficult for those centrists and those moderates. We should also note, Tom, I'm glad you brought up those percentage points. Congressman Matt Gaetz yesterday wanted to bring up the Hastert rule, which isn't a real rule, but something a lot of Republicans like to live by, the majority of the majority. And he says that's his issue of why he has a big concern with Ukraine aid, because the majority don't report on the Republican side. Yet, he doesn't care about the majority when it came to ousting Kevin McCarthy.
And does Congressman Gaetz still have the support of his constituents?
Listen, he is in a deep red district. And what he has been doing off of this is fundraising. And I'm not sure how much money he's been making on that. I'm not sure he knows just yet as well. But he was fundraising off of ousting the speaker And he says that he is bringing common sense back to Washington. No longer of these omnibus bills, no longer of these stopgap funding measures, but he continuously talks about these 12 appropriation bills, which we should know the House had been doing work on, maybe not fast enough. But he's in such a deep red district that he has some support, but it's on shaky ground. The New York Times did a big deep dive into how he is a little bit controversial as well back home.
And Marie, there's a question about just how much consensus there is aside from what people call the fringes. And yet yesterday, Patrick McHenry, the interim speaker, evidently reportedly kicked House Speaker Nancy Pelosi and former Majority Leader Steny Hoyer out of their office to put Kevin McCarthy as sort of an emeritus House Speaker role to that space. Does this speak to a real animosity that's going to make it very difficult for anything to get done and for Congress to get back up and running?
Well, first off, Congress' first order of business is they need to elect a new speaker. There's a lot of debate about how much power an interim speaker like Patrick McHenry has. Can he bring actual bills and legislation to the floor? We're looking at potentially a government shutdown come mid-November. When you're looking at Steny Hoyer and Nancy Pelosi being kicked out, you know, is that just retribution? This is not their full-on congressional office. This is a hideaway office within the Capitol. But I think it was quite telling that Speaker McCarthy, when he had that Q&A with reporters, he said that he gave this motion to vacate rule, that one individual can oust the speaker. He said he gave that to the far right as part of those conversations because he said, Nancy Pelosi said to him, give it to him, I'll always have your back, I want to protect the institution.
MH, just want to finish on this, consequences of all of this. Do you sense the president is softening on certain issues regarding border security and doing so in exchange to get Ukraine aid?
Well, we do know that the president wants to start building 20 miles of a wall, a part of that's a border of Texas and Mexico. We also should note today we do have Secretary Blinken, Mayorkas, Merrick Garland in Mexico talking about fentanyl, migration for the Mexican side. They want to talk about guns that are coming into Mexico. So you do see the president having to focus on this. But Jonathan, I don't know if it's because what's going on in Congress or it's because what he's hearing from Democratic-controlled cities. Mayor Adams is also making a trip to the border this week. And then you had that letter from Governor Pritzker of Illinois sending to the president saying more needs to be done about what is going on at the southern border.
Becoming
so he's getting a lot of pressure from his own party.
Massive campaign issue potentially, AMH, for next year, isn't it?
Yep.
Yeah, 100%.
AMH on the latest down in Washington, D.C. Anne-Marie, thank you. A real softening from the president, Tom, on that issue. To AMH's point, and I think it's the right point, it's not just about Ukraine aid. This is about pressure within his own party, from his own Democratic colleagues in blue states and blue cities.
And it's serious enough now. I mean, the governor of Texas has got to say, well, I guess I jump-started that debate. But the answer is, you mentioned earlier, Mayor Adams of New York is in parts of Central and South America talking it up. Lisa, I thought you had a great, point there. I mean, this is front and center. Pritzker of Illinois is fired up.
My problem with it is just, I don't know that there's actually any kind of ability to come to a consensus about actual rational immigration policy that would need to be changed in order to really create a situation, right? I mean, it's going back to some of the classic hot button issues that are sort of just,
I think America's not on the same page as the politicians. I think America's got a whole other view, and all of them don't want to talk about it.
Kelsey Barrow, JP Morgan, Asset Management, joining us very shortly on this bond market. What a month it's been. Your 10-year now, 472. Yield to lower, a single basis point. From New York, this is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Great guest coming up on the bond market, so let's whip through the price action and some stories for you. Equity futures on the S&P 500 looking like this, pulling back by 0.15% on the S&P, following the biggest one-day pop, one-day rally on the S&P going back to mid-September. On the Nasdaq, going back to the end of August. In the bond market, we look like this morning. A rally yesterday, triggered, inspired by a big downside surprise on ADP. We'll see if that changes with jobless claims later and payrolls on Friday. Yields down again, just a single basis point. The 10-year, 472.27. A 30-year had a look at 5%, pulled back. We're all the way back down to 486.93. We're up a single basis point, which incidentally I think is where the 10-year was yesterday, which is where the 30-year is now. So bear that in mind, just how quickly things have moved in the space for trading session. In foreign exchange, we're shaping up as follows. The euro showing a ton of weakness against this strong almighty dollar over the last couple of months. 105.19 against the US dollar. That currency pair is positive by 0.1%. Under surveillance this morning, Chicago Fed President Austin Goolsbee saying the timing of the bond sell-off has been something of a, quote, puzzle, given there was no major change in the Fed's latest projection. Speaking to the Odd Lots podcast, he said he's confident the US is on the path to the mother of all soft landings. Today we'll hear from the Fed's Mester, Kashkari, Barkin, Ambar, and Bramo's going to be sitting down with Mary Daly of the San Francisco Fed. Lisa, this from Andrew Hollenhorst of Citi just moments ago. Fed officials won't push back on higher Treasury yields. We'll see if Mary Daly does a little bit later.
They're not going to push back if it really confirms the higher for longer thesis. We even heard Raphael Bostic, often thought of as a dove, coming out and saying higher for longer, higher for longer. They want this. This is going to actually affect their policy. I do have to say, the mother of all soft landings, we can't let that go. You can't. I mean, this is sort of the irony of the moment, right? How do you reach this perfect equilibrium and create a drama and a romance around it that you normally get with a crash, a sell-off, a massive rally, etc.? It's like, you know, the mother of all soft landings.
Some of that's the language of Goolsbee. I mean, he's known for that. But the word puzzle there is a code word for, John, we don't have a theory on this.
True.
Puzzle, I see in academic literature, Greenspan would say, I'm puzzled. And what he means is there isn't a book that can explain this to him. And where we are in bond price losses now, there is no book. As I said earlier, folks, we are at, on this Thursday, never, ever, so's Austin Goolsbee.
There's so much confusion, Tom, because there is so little confidence about what has driven this move over the last month at the long end, on a 10-year, on a 30-year. Crude has been all over the place, posting its biggest one-day loss in a year. The WTI falling close to 6% yesterday, the most since September of last year. Ed Morse of Citi writing that the rally in crude has reversed as, quote, bond markets have been signaling economic weakness and US gasoline demand continues to lag. Collapsing prices likely informed the OPEC Plus decision to stay the course on output cuts to year end. That's an interesting interpretation, Bramo, of what's happening in fixed income?
Yes, I would agree with that. I also think it speaks to the fact that we don't understand what's driving a lot of markets. And what did you call it? Narrative table tennis? Who is the one who coined that?
That was James Athey of Aberdeen.
I really lean into that because right now it just highlights how you can create a different narrative around the oil market, around the bond market, depending on who you talk to and how you frame it. And it feels like, depending on the day and depending on the price action, we get a different one.
Have bonds been signaling economic weakness? I think there might be the recipe for it. I'm not sure they've been signaling it. Typically what you'd expect for a bond market signaling weakness would be maybe a bull steepener, rally at the front end because we're about to get a ton of rate cuts, maybe a rally at the long end because you're pricing in lower growth and rate cuts in our future, 10-year rallies, 30-year rallies. That's not what we've seen over the last month.
100%, you're absolutely correct. And if anything, it's really signaling strength. However, some people could argue that finally the bond vigilantes are pushing back against a fiscal instability that they're feeling in the U.S. economy that could speak to a weakness going forward that I can tell that Tom really leans into.
I really disagree with this. John, there was a log convexity, which is an John. There was a log convexity here where there was a stabilized drift function. No question about it. Guess what? Like a rock out of the Leaning Tower of Pisa in Italy, the rock dropped and we're in a free fall.
Nobody today.
And the free fall that we're in now is simply, just like in equity, the bid went away.
Yeah.
I wouldn't overthink it. The bid went away.
Ian Lingard-Beamer, buyer's strike.
Yeah.
That kind of sums it up,
Bid
doesn't it?
just walked away.
Last story, President Biden has sent his dog away, Commander. He's going from the White House. This is the second German Shepherd that Biden has had to relocate following at least a dozen biting incidents involving White House personnel. We'll get so much stick for this story. Commander's gone, TK. I know you've been following that closely.
I got home. Vet Bill was really upset. Kennel Fee's like, yeah, what took so long?
Yeah.
And, you know, I frankly had dogs like this. It's not funny. And the answer is, what in God's name took so long? I mean, that's my only question. If a dog bites, a dog bites.
Do we know where Commander's gone?
Yeah, they take him up. They take him up a northern road in the Adirondacks.
Stop it. Get to the next
north
guest.
of Utica and Rome. North of Utica.
I mean, literally, that is on you.
North of Utica and Rome.
How the carrier's gone to the farm.
Come on, let me finish. Guys, north of Utica and Rome, just before Old Forge. Just before Old Forge, John, Uncle Bud.
I feel bad.
We got a great guest. Commander's at a safe home if there's any children listening.
Kelsey Barrow is probably going to walk off the stage. You got something to read here, John? I'm sorry, I lost the scripture. I was laughing so hard.
No, I don't.
We're going to go into this, and right now for Global Wall Street, we're going to freeze time. We're going to get through this for Bob Michael and Kelsey Barrow because they're the real deal. They're at J.P. Morgan Asset Management, and we're going to ask a really delicate inside baseball question so she can go back to the new skyscraper on Park Avenue. Explain without addressing your bank, your business. Mr. Diamond would say that's appropriate. The decisions being made right now of my bond losses, I have to mark to market versus I can hide them somewhere else. Go.
Right. So we've been talking about the losses in the bond market. I think it is important to put into context, though, the majority of the pain was last year, right? The U.S. Ag was down 13% last year, down 2% this year. But more recently, we have seen this backup in yields and this pain that's coming. Now, I think the reason why the stress in the banks has been a little bit less acute this time around than in March is because of the BTFP program, so the Bank Term Funding Program.
Right.
Close, not exactly though. So BTFP, the Fed put that in place in March, and I think if there's one thing that really was crucial to turning the markets around at a point where we were very stressed, we were very uncertain about how things would go in the future, that BTFP program was important because banks can now pledge those treasury securities, and even though they have a price in the marketplace of $70 or $80, they can be pledged at par. So there's been this stabilization factor that was not there back during the March crisis.
So we're saying as these unrealized losses get greater, they matter less?
They are mattering less right now. I think there is still stress, though. This is not the end of the story, right? Even though this facility is in place, people are using it, there's $108 billion in the facility, there still is going to be pressure on margins. You know, it's not only about the mark-to-market losses, but it's about the fact that net interest margins are under pressure. So, you know, as an investor in financials, you do need to be very cautious about where you're investing, understanding the portfolios and the balance sheets of the banks that you are investing in, and being aware of the game changer that was the way the Fed reacted back in March.
Are the bank's ability to finance the economy curtailed by the dynamics we're talking about? Are they constrained?
Yeah, so if you look at the H8 data, and I love to look at this every single week on Fridays, I'm looking at Lisa because I know she looks at it too.
All the time.
What you're going to see is that credit has been contracting in the economy. If you look at C&I lending over the last 3 and 6 months, it's negative. If you look at the Senior Loan Officer Survey, it's showing that there is tightness in credit conditions. And like you mentioned, Lisa, this is exactly what the Fed wanted, right? They want to engineer tighter financial conditions. So I disagree with the quote from Goolsbee that he doesn't know where this is coming from. I really do think that this stems from the September FOMC meeting and the dot plot. Sure, they still showed cuts next year, but what they showed is a real policy rate that actually goes up by 50 basis points next year. That is a very hawkish message, and the market is still trying to digest that right now.
So if we're talking game theory, this is basically the idea from your perspective, it sounds like, that the Fed is trying to signal hawkishness so they can engineer the landing so that then they can reverse course and cut rates. How do you respond then to people, including what we heard from Dalip Singh over at PGIM, that there is a structural change in the bond market where some of the long-standing price-insensitive buyers are no longer there?
So there has been a big repricing, and I think this is why you need to look at this not just from an emotional perspective, not just from the ping pong narrative, but also from a logical perspective. What do valuations look like right now, and what are the guardrails to those valuations? Look at the five-year real yield right now. It's around 2.3%. That is the same, or the average rate that the five-year real yield was from 2003 to 2007. So we've already repriced not just to the pre-COVID levels, but to the pre-GFC levels. So regime shift has really already happened. In our view, it's actually an overshoot. But it's already happened.
Although I will just push back, and I know that you've been bullish on treasuries and talking about going back down to 3%. Have you reconsidered that call at all, especially in light of some of these structural changes? Yes, we can talk about inflation, but Torsten Slok of Apollo just putting out Treasury auction sizes will increase on average 23% in 2024. We have evidence that a lot of the central banks around the world, traditional buyers, are no longer buying. Doesn't this change your outlook more materially?
So the technicals do matter, particularly in the shorter term horizons, but we do think ultimately the fundamentals and the valuations are going to weigh over those technicals over the medium term. Inflation right now, the 3-month run rate on core PCE is 2.16%. I mean, we're at the Fed's target. We're not in the 1970s and the 1980s here in terms of the economic growth environment or the inflation environment. I think that there has been a buyer strike.
Cut to the chase. They're fighting the last war. Is that what you're saying? You're having coffee with Mike Ferroli over at JP Morgan. Can you guys agree Goolsbee and the rest of them are fighting the last war?
Yeah, they're fighting inflation that I think is already clearly coming down. And I understand why they're going to wait until it's painfully obvious. But in my mind, that only just reinforces the risk that hard landing should be much more of a higher probability than soft landing, because the Fed is telling you, we're not going to stop until it's painfully obvious that the economy can't handle it. And the housing market, you look at the mortgage application data from yesterday, it clearly can't handle it. We think that the economy is not going to be able to handle these rates, but the Fed is going to be the last to admit that.
10-year right now, 472. Cassie Barrow there of JP Morgan Asset Management.
Brilliant.
If you are just tuning in, welcome to the program. Your S&P 500 shaping up as follows. On S&P 500 futures going into the opening bell, we look a little something like this. We're negative just 0.01%. So Cassie, listening to you, it sounds like screaming buy, 10-year, 30-year. Both hands jump in right now. Is that right?
That's your phrase.
What would you say?
I mean, I would say that we do see value in bonds here. We're going to look back over a longer term horizon. And we're going to say this was an attractive entry point. You do have to be respectful of the technicals, though. We've been buying on the back up. We paused when things got disorderly, when we broke through 450, because we do want to be aware of what's going on. But valuations are attractive here. This is a good entry point for yield investors.
Have you seen enough in credit yet? We've seen some spread widening. Not enough?
Not enough, not enough, particularly in high yield. It just feels perfectly priced for the soft landing. All-in yields are attractive. If that's all you're looking at, high yield at 8 to 9%, that is very compelling, especially versus historic equity market returns. But if you're just looking at it on a spread basis, that spread market is telling you 80%, 90% probability of soft landing, not a lot of cushion for any type of downside risk. And the market, like you said, it's never land out there. We think we can never have a recession, never see growth slow, never see inflation come back to target. And I would challenge those ideas.
Soft landing, hopes and dreams, TK.
That was, so everybody understands, that was an absolute clinic on so many different fronts from Ms. Barrow.
Kelsey, that was awesome. It's good to see you, as always. Coming up a little bit later, Mark Giannoni of Barclays at about 8:30 Eastern time when we get jobless claims data in the next hour. That data just around the corner, going into payrolls tomorrow. Live from New York City. Good morning.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Connection Live. In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
I am frustrated beyond words. There is this obstacle to governance. You know, we have our disagreements. We differ on issues, but what's happening in the House is just total chaos. We will be moving ahead with the 12 appropriation bills. We have to do our job, and we're going to just let the House hopefully do its part, but we have to move ahead.
That's a struggle right now. That was Senator Richard Blumenthal of Connecticut speaking to Bloomberg's Romaine Bostick and Scarlett Phil on the close yesterday. From New York City this morning, welcome to the program. The S&P 500 just about unchanged to that line in the sand, just south of it, 0.01% negative. In the bond market, yields are a little bit lower by a couple of basis points. We're back down to 471.44. Some massive ranges in the Treasury market yesterday. On a 30-year, we had a look at 5%, then pulled back. We're back down to about 486. Yields unchanged this morning, Tom. Sparking a move yesterday, the ADP report, downside surprise. The appetite for payrolls tomorrow. Jobless claims coming a little bit later this morning, so another read on the U.S. labor market.
1/4 of Tom Keene, John Farrow, is an island off of Norway, and they came over from Northern Europe and they went to the Midwest. At the time, it was called the Northwest, and they went from Western Ohio up through Western Michigan out to Fargo, where Lisa spent some serious time. And it was a whole Germanic and Dutch exit. It was amazing. Like the accents are different.
Right.
Until the 19th century, huge non-use of English. And our next guest is a real Republican from a conservative Dutch part of this United States.
I thought
of
you were saying
America.
that I'm 1/4 of Tom Keene.
No, the
Most people would agree with
Hadsel family, which I'm sure Heisinger
No, I
knows.
meant intellectually. I didn't mean Bramo. That's rude.
The gentleman
rude.
from Western Michigan,
That's
outside
not
Grand
nice.
Rapids on the fields of Michigan,
I know what
joins
you're
us
thinking.
now. Bill Heisinger. Bill, you know, the thing that we've seen for the last 36 hours, I actually thought of you, and that Newt Gingrich has identified it as 4% of GDP. We went from Lincoln, southwest of your family's heritage, to 96% of the GOP in crisis. How do you people get back control of the party? How do you get back control of the narrative?
Yeah, that's a great question. In fact, I happened to see former Speaker Gingrich last night at a dinner. But it is interesting. I do have to comment. You know, you played Senator Blumenthal's quote. And yes, the House is a bit of a mess right now. But I would just point out those who live in glass senates shouldn't throw stones, all right? Because they have not done anything when it comes to the appropriations bills until this year. And it was only when the House threatened and really pushed this whole notion that we needed to pass those 12 appropriations bills that they actually passed anything out of committee. So I'm glad to see that people are realizing that these massive Christmas tree omnibus bills are a horrible way of moving forward. But yes, we've got a mess in the House. We can't do anything until we pick a speaker, and hopefully that's going to come sooner rather than later. But I'm not sure that we're there yet.
I look, Congressman, at the joy that America has. That maybe we ought to have some successful small business people in Congress. You're one of them. You're the gravel of Michigan, running gravel, moving it out, building things in that. How do we take advantage in this crisis of a beleaguered small business? I think it's been ignored here for weeks and weeks.
Well, first of all, you got to stop crushing them. And whether it's at local level, state level, you know, I'm a former state legislator. I know what can happen on the regulatory side as well as the tax side, and certainly here at the federal level. That is writ large, but we also know the inflation impact has been massive. And I was interested in hearing, I think it was Kathy, who was on just prior to me, talking about this soft landing, hard landing situation. A lot of us would argue that the Fed was late to the table in starting to move those interest rates up, and now we've been paying a massive price, literally, for that on the way down. But we got to stop this tax and regulatory crushing, plus the rhetoric, right? I mean, it's you know, small business drives the economy in so many places, and a place like Michigan, all right, we're watching.